Now referring to you, time of supply. For supply of goods, forward charge apply. Simple. Supply involves movement of the goods. Supply does not involve movement of the goods. Invoice should be issued before supply. Before supply. Last date to issue invoice or date of invoice, whichever is earlier, is the time of supply. That's it. Payment does not matter here. Does not relevant factor here. Only in the case of online money gaming, date of invoice, last date to issue invoice, or date of payment, whichever is earlier. Online money gaming alone is clear, my dear friends. Coming to supply of goods, reverse charge applies. In the case of supply of goods, reverse charge is applies. Time of supply here is equal to the following three factors are relevant: date of receipt of the goods, date of payment, or the 30 days expires immediately after the expiry of 30 days from date of invoice. Means first day that occurs after expiry of 30 days from date of invoice, whichever is earlier, is clear. If the supplier is a registered person, recipient is a registered person, supply of goods, the recipient should issue the invoice as per section 31, section 3, clause F, is within 30 days from the date of receipt of the goods. Issue the invoice. Is clear, my dear friends? Any difficulty, my dear? Coming to supply of services, forward charge applies. In case of supply of services, forward charge applies. Invoice issued within 30 days from the date of the completion of supply of service. If yes, date of invoice or date of payment, whichever is earlier. If the invoice, in case not issued within 30 days from the date of the completion of supply of service, or may be issued before the completion of service, as the case may be, time of supply is equal to date of completion of supply of service or the date of payment, whichever is earlier. In the case of a banking NBFC, 30 days replaced as a 45 days time period. Is clear, my dear? In the case of reverse charge comes into picture, supply of services, reverse charge applies. In that case, place of the time of supply is equal to group in two parts. One is, have you import the services being an associate enterprise from your counterpart, from other counterpart. Yes, sir, I am associate enterprise, sir. My parent company from whom I import the services, sir. In that case, time of supply is equal to and reverse charge, date of payment or date of book entry made in the recipient books, whichever is earlier. No, sir, my import of services not from a parent company, sir. We are not associate enterprise, sir. Import of services, sir, or a service is generally fall under reverse charge, sir. Section 9, section 3 of the CGST, sir. In that case, recipient liable to pay GST. Time of supply is equal to date of payment or the first day that occurs after expiry of 60 days from the date of invoice issued by the supplier. In the case of a supplier is a registered person. If is a unregistered person, in that case the law here says date of issue of invoice by the recipient in case where the invoice issued by the recipient. Get my points? Time of supply in the case of RCM apply, supply of services, date of payment, or the first day that occurred of expiry of 60 days from the date of invoice issued by the supplier, whichever is earlier. If the supplier is a person, date of payment or date of issue of a invoice by the recipient. If the recipient is liable to issue invoice, whichever is earlier. Is clear? Further, my dear friends, I mean to say here is, if the supplier issue the invoice, 60 days applies time period. The first day that after expiry of 60 days from of issue of invoice by supplier or date of whichever is earlier. If the recipient liable to issue invoice, 60 days not applicable. Date of payment or date of issue of invoice by the recipient, whichever is earlier, is the time of supply. Get my points? Got the clarity? Further, in the case of change in effective rate of tax, in the case of change in effective rate of tax, my dear, As you are aware of that, rate of tax, majority principle. What do you mean majority here? One is invoice date, completion of service date or supply of service date. The third one is date of payment. Among the three, any two is supporting which one particular rate. For example, invoice issued when the rate was 18%. Payment received when the rate was 18%. Service only completed when the rate reduced to 5%. What rate apply? 18% apply. With regard to time of supply, date of invoice or date of payment, which is supporting with the date of completion of service. If invoice supporting, invoice date. Payment supporting, payment date. Neither invoice nor payment is confirmed with the date of completion of service. In that case, date of invoice, date of payment, whichever is earlier, time of supply. We refer to regular class. Am I right or not? In case of supply of goods, my dear, rate of tax remains same, majority principle. Date of invoice, date of completion of supply, date of payment, amount whichever is earlier, whichever may be the majority, that will be time of rate of tax. Time of supply in case of change in rate of tax for supply of goods, date of invoice or last day to issue invoice, whichever is earlier. Is clear, my dear? That's it. Time of supply backup. Remaining as Duzubi, what are they? Voucher, interest penalty. Interest penalty at the time of receipt. Voucher in case of redemption, any product redeemable at the time of redemption. If a specific product or service at the time of issue of voucher is the time of supply. For default provision, date of payment. If the due date is ascertainable, not ascertainable due date of payment, then date of payment of tax is the time of supply. Is clear, my dear friends? As simple as that. Is clear? Time of supply is over. Next. Now referring to you, valuation under GST law, supervision. Somebody called marathon, but I will call supervision. Just like that, revise. Valuation, Raja, very simple. If the supplier and the buyer are non-related parties, the price has sole consideration. Valuation, as simple as that. Took the value of supply from the books. If not added, following you add it. 1. All type of taxes and duties except GST taxes. Here one should be alert. Should not add the TCS under the Income Tax Act under section 206C of Income Tax Act. That TCS should not be charged here. Add. Is clear, my dear friends? Thereafter, add if not added the what we can call it, the supplies made by the recipient on behalf of the supplier. You add it. If not added, further add commission. Further add other charges. If not added. Sir, what commission you are referring here? I will give one clue. One clue means one important advanced concept here. See, I am an e-commerce operator. I am charging commission rupees 100. The value is net value 10,000. I want to get from that 10,000 rupees. For example, 1,000 rupees I want to get. I have to pay to my vendor only 9,000 rupees. Now here, 9,000 is the value. My commission how much? 1,000. If I want to charge the GST, on what value should charge the GST? On my commission. Is clear? This commission 1,000 rupees I am liable to be GST. But I am liable for TCS, no? For TCS purpose, what is the value? Not 9,000. 9,000 plus this commission of 1,000 for TCS purpose. Is clear? Under 52 of the CGST, Raja, 2.25% CGST, 0.5 GST. On what value means? Not on 9,000. 9,000 plus my commission of 1,000. On 10,000 rupees only I have to charge TCS. Effectively 0.5% CG, IGST, TCS. Is clear? Is a concept, valuation concept. Thereafter, if not added, add interest, late fee, penalties, if any, which is main supply taxable, the accretion there are also taxable. Further, add subsidy from person other than the government. If government subsidy should not be considered for taxation purpose. Is clear? And another value. From the deduct discount. What type of discount given before supply or at the time of supply, mention invoice to be given subsequently. If not invoice, agreement should be there. Neither agreement nor mention invoice. Later on, give the discount, which is not allowed as deduction. Which is not allowed as a deduction. Got the clarity, my dear? If the supplier and the recipient, related parties, or the price has no sole consideration, wantedly, deliberately kept below the market price and selling to cause the revenue loss. In that case, refer the valuation rules. In this process, you have to refer rule number 27. 27. 27 has 4 categories. One is open market value. If not a sum total of concession equal to money value. If not a like and quality. If not a cost plus 10% profit. Rule number 30. If not a best judgment, department will take up. Rule number 31 is clear. Then rule number 29 comes into picture. What it talks about? Rule number 29 talks about. Rule number 29 where should go? Rule number 28 is there now in between. After 27, rule number 28 is there. A transaction between related parties, a transaction between the distinct persons. Valuation of open market value. If not a like and quality of the goods, if not a cost plus 10% profit, namely rule number 30, if not 31. Otherwise, proviso 1. Proviso 1. Rule number 28, proviso 1, which says that if the recipient subsequently says that on that 90% is the value of supply in hands of the supplier, where the recipient not eligible to claim full ITC. If the recipient eligible to claim full ITC, proviso 2, which talks about whatever value shown in the invoice is the open market value. 0 and 0, no invoice, where the recipient eligible to claim full ITC. The same principle also be extending to rule number 28, the second proviso, rule number 28, sub number 2. Rule number 28, sub number 1, first proviso, second proviso. First proviso says input tax fully kadiyadu. Recipient cannot have full input tax credit because he is supplying the taxable as well as some goods. Therefore, he can claim full input tax credit. In that case, 90% of the value at which he is selling recipient, that is the value of the supply by supplier. If the full amount of input tax is eligible to avail by the recipient, then whatever the value shown in the invoice is the value, open market value. If not shown, 0 value, open market value. Meaning thereby, full ITC eligible to avail by the recipient. Rule number 28, sub number 1, second proviso says that not required to pay the GST. Show 0 value in the invoice, pay the 0 tax. Is a benefit. This is only applicable when if the recipient is eligible to claim full amount of input tax credit. Coming to rule number 28, sub number 2, corporate guarantee. As an individual director, you are allowed to give the corporate guarantee to your company, but you should not charge as per the RBI guidelines. If so, 0 value is the value of supply, is the open market value, even though they are the related parties. If a corporate company giving the corporate guarantee to its own other corporate company, means a holding company giving to subsidiary company corporate guarantee, in that case, even though the charge is not charged, the consideration will be considered as follows. 1% per annum on the corporate guarantee amount or rupees. How much? They given rupees. Actual consideration, whichever is higher, 1% on the corporate guarantee amount per annum. Suppose corporate guarantee is given, Raja, for 5 years, 1 crore, 1% equal to 1 lakh. 1 lakh into 5 lakhs. Or actual consideration, whichever is higher. No, sir, corporate guarantee given only for 9 months. Oh. Corporate guarantee how much? 1 crore. 1% 1 per annum. 1 crore on which 1% equal to 1 lakh is per annum. But guarantee given for 9 months. 9 by 12. 1 lakh into 9 by 12. That value compared with the actual consideration, whichever is higher. Got the clarity? Suppose if the recipient company eligible to avail full ITC, then zero value shown by the supplier of corporate guarantee is the open market value. That principle apply here also. You shouldn't apply 1%. Ayya babu, be careful. Rule number 10, rule number 27, sub number, rule number 28, rule number 28, sub number 2. Proviso, first only one proviso says that 1% per annum of the corporate guarantee value or actual consumption, whichever is higher. The 1% per annum basis is clear. If the recipient eligible to claim full amount of ITC, 1% concept not applicable. Whatever the value shown in the invoice is the open market value. Zero value shown, zero value. Invoice issue pannale, zero value. Where the recipient eligible to claim ITC, full ITC. What is the meaning of full ITC avail? Meaning the recipient is paying the tax and wholly at the output supplies, not having any exempted supplies. No exempt supplies is there. In that case, is clear, sir? Coming to rule number 29, which is nothing but a principal agent covering under schedule 1 point number 3. Which one will cover there? A particular supply of goods supplied by the principal to his agent, where the agent undertaken to supply the goods on behalf of the principal. That means agent should issue the invoice in his own name, or supply the goods by the agent to his principal, where the agent undertaken to receive the goods on behalf of the principal. In that case, they are covering under the clutches of schedule 1 point number 3. If so, a principal supply the goods to agent, how to earn the value in the hands of the principal? Means open market value. If not, like kind and quality. If not, cost plus profit. If not, residual value. Rule number 31. Or otherwise, open market value is available. Compare with that 90% of the value at which the recipient supply to others. Amount whichever is less will be the value. This is economical for you at the option of the supplier. It depends. Is clear? Rule number 30, cost plus 10%. The cost should be arrived as per the cost accounting standard number 4. On which? Cost of production for a manufacturer, cost for a trader, cost of service for a service provider. All the three covered under CAS 4, cost accounting number 4. As per that, you arrive the cost before adding the admission, the admin overheads as well as selling and distribution overheads. Is clear, my dear friends? Further, rule number 31 already covered. Rule number 31A, nothing but what? Lottery tickets. The MRP value, remove GST. Notified price in the official gazette, remove the GST. Amount of whichever is higher is the value. In the case of betting, gambling, and whatever the bet value, 100% is the value of supply. In the case of online money gaming, what is the amount deposited in the wallet is the value of supply. If you winning and redepositing the same game, not a supply. If you winning and depositing in the other game of the same wallet is a supply again. Is clear? Rule number 32, where we have 32 class A. Rule number 32, sub number 2, class A, money exchanger. 3 cases are there. One is actual exchange rate compared with the RB rate. The difference multiplied with the foreign currency is the value of transfer supply. In the case of RB rate not available, multiply the actual exchange rate with the number of units foreign currency and the total apply 1%, that is equal to value of transfer supply. In the case of cross currency, 2 units of the foreign currency converted into Indian rupees by multiplying with the RB reference rate. Among the two values, whichever is lower value, choose apply on which 1%, that gives you taxable value of supply. புரிதாம நான் சொல்றதே அர்த்தம் అవుతుందండి మనసులై. Now coming to Other option, rule number 32, sub number 2, class B, is if you opt the option, you should be stand with that option till the end of the financial year. What is that? Up to 1 lakh value of exchange, 1%. Minimum 250 per transaction. 1 lakh to 10 lakhs means 9 lakhs, 0.5%. Beyond 10 lakhs, with the upper limit, 0.1%. Minimum 250 per transaction, maximum 60,000 per transaction. With that, you are the value. Here, only actual exchange is the base to convert to the foreign currency in Indian rupees. Clear? Is the only methodology available for money exchanger. Money exchanger not allowed to pay the GST and the commission. Money exchange liable to pay GST only on valuation rules. Either rule number 32, sub number 2, class A or class B. Is clear? Rule number 32, sub number 3. Air travel agent is only applicable air travel agent, not to train travel agent, bus travel agent, air travel agent. In that case, commission pay the GST, if not, valuation rules. Rule number 32, sub number 3 says that for domestic travel, basic airfare, 5% value, tax of supply. International travel, 10% of the basic fare is value of supply. Is clear? On with GST. Or the GST on the commission basis, whichever is economically follow. Case to case you follow. Unlike of rule number 32, sub number 2B, where you opt that you can withdraw that until the financial year get over. But here commission agent, air travel agent, transaction to transaction you can choose. If you want valuation rules basis to pay GST or commission basis to pay GST. Commission here includes year-ending bonus. Get my point, sir? Further, rule number 32, sub number 4, which talks about life insurance companies. Maybe it is going to be down the line, it is going to eliminate. Reason, from 22nd September 2025 onwards, the insurance companies, especially life insurance companies, medical insurance companies, are free from GST, whole amount exempted. So that time not required to refer this rule, but presently in coming exemption we have this rule. Rule number 32, sub number 4 talks about if an insurance company providing risk plus savings, if so, what is the exact saving is mentioned in the particular agreement, that amount will deduct from the premium, balance will be taxable. If not known, 25% of the premium is equal to taxable supply for first year premium. Second year onwards, 12.5% of the premium equal to taxable supply. In the case of single annuity premium, 10% of the premium amount is equal to taxable supply. Got my point, sir? Got it, sir? Then further, rule number 32, sub number 5, which talks about second hand goods, margin method, sales minus purchases. If I have the margin, pay the GST, provided I should not avail the input tax credit. In the case of a banking company, what is the cost of purchases if they repossess the goods on account of a default of a particular borrower? In that case, the purchase price of the cost price to the borrower is the cost price for the banker after reducing 5% per quarter, part of the full quarter from the date of repossession of that particular asset till the date of disposal. The balance amount is the cost of purchases. That you compare with sale value. Sale is more than the purchase margin. On the margin, pay the GST. Is clear? This is applicable only when you are not eligible to claim. You are not claiming ITC. You should not claim ITC. Then only this method is applicable. Only dealing with the second hand goods. Thereafter, coming to rule number 33. Rule number 33 is nothing but what? Pure agent expenditure. Expenditure incurred by the supplier on behalf of the recipient, where the expenditure, the benefit of the expenditure not enjoying nor owned by the supplier is called pure agent expenditure. For example, client income tax paid by the auditor and reimbursing it should not be charged the value of supply. Get my points? At the same time, my dear, Residential Welfare Association collecting the maintenance of electricity bill of an individual on cost to cost basis and remitting department. Is the value of supply for the RWA? No. So as long as the supplier provides these services on behalf of the recipient, that is belongs to the recipient expenditure incurred by the supplier and getting reimbursement, is not the taxable supply. Is a pure agent expenditure, should not be added in the value of supply. It's clear, my dear friends. Rule number 34, exchange rate. In the case of services, gap, generally accepted accounting principle. In the case of goods, imported goods, exchange rate of the CBS is the time of submission of bill of entry. Export of goods, exchange rate of the CBS is the time of submission of shipping bill. In the case of services, gap, generally accept accounting principle, nothing but what? Open market value. Rule number 35, taxable value is equal to gross value multiplied by 100 divided by 100 plus GST. If the value is inclusive of GST basis now. Is clear, my dear friends? With this, valuation is completed for you. Marathon, supervision. Refer to now, input tax credit, chapter marathon. Super revision is to come. Sir, sections 16, section 17, section 18, section 19, section 20, 21 covering under the input tax credit chapter. Section 16 talks about terms and conditions one should satisfy to claim input tax credit. Where we have section 16, subsection 2, class A. The person who want to claim input tax credit should be possession of tax invoice or debit note issued by the supplier. Section 16, subsection 2, class AA, also we have here a newly inserted class AA, where the details of the invoice of the debit or invoice or debit note referred in clause A, namely section 16, subsection 2, class A, has been furnished by the supplier in the statement of outward supplies and has detailed have been communicated to the recipient of such invoice or debit note in the manner mentioned under section 37. Meaning thereby, listen to me, supplier should issue invoice or debit note. It should be possessed in your hand by recipient, and the supplier who issues the invoice or debit note should submit his GST when return. Then it is communicating to me in my GST to be written as my credit, eligible credit. Is clear, my dear? As my eligible credit. That means section 16 to A. The recipient should be possession of tax invoice or debit issued by supplier. And class 16, section 16, subsection 2, class AA, supplier should furnish GST when return. Is clear? Thereafter, we too have class B. Class B what? Talks about the recipient should receive the goods or services. The recipient should be receive the goods or services. Section 16, subsection 2, class BA, which talks about that credit should be reflect in the books of the accounts of a recipient in the GST to be written as eligible credit. Section 16, subsection 2, class C, where the supplier should pay the tax to the department by filing the GST 3B. Class D2, section 16, subsection 2, the recipient should file the return to avail the ITC. You get my point? So a summation of this in a simplified manner present, look and understand. Section 16, subsection 2, clause A, which says the recipient should be in a position of tax invoice or debit issued by supplier. Section 16, subsection 2, clause AA, the supplier should file the GST 1 return. Section 16, subsection 2, clause B, the goods or services should be received by the recipient. Thereafter, section 16, subsection 2, class BA, ITC as per GSTR 2B to the recipient should be reflect. Section 16, subsection 2, class C, where the supplier should pay the tax to department. Section 16, subsection 2, class D, the recipient should file the return. GST 1 and GSTR 3B. Then only ITC is allowed. Now, here and there some points are there, my dear. What about a case where if the goods not received by the recipient, can he be considered deemed receipt? There is a deemed receipt concept is there. Recently, there is a one particular amendment also I referred in the regular class by saying that in the case of X works contract, where the manufacturer manufactures the goods on behalf of the buyer. Buyer is a dealer of the vehicle where the goods has been picked by the buyer from the manufacturer seller point of view, from the seller factory. Then in that case, that time itself deemed to be received by the buyer. The buyer can avail the ITC that time itself, not required to wait till the time to reach the physically the goods. Meaning what? Amendment. Deemed receipt of the goods. Example. My name is Honda. Your name is X Limited. You are manufacturing vehicles. I given the vehicles 10 vehicles order. You manufactured it. After you manufactured, you have been pricing me 10 lakh rupees, for example. With the GST, for example, 18%, 1 lakh 80. The invoice raised by you on 1st of January 2025 is clear. The goods supposed to come to my place by 31st of January, but unfortunate, it came on 1st of February 2025. Now, my goods you hand over to my transporter at your factory on 1st of January 2025, invoice date 1st January 2025. The date is deemed to be received by me. So, I can avail ITC when? In the month of January, in the month of February? In the month of January itself, I can avail the ITC, is the meaning of it. Deemed receipt of the goods. Got the clarity? Further. Sir, what about? Am I required to pay the payment to my supplier as a buyer? Yes. Within a period of 180 days from the date of invoice, if I purchase the goods or purchase the service on credit basis, if I avail the ITC, it is my obligation to make the payment to my supplier within dash number of days. Within 1 days from the date of receipt of the from the date of invoice. Sir, what about if the goods are coming to a place lot by lot, when I can avail the ITC? When I receive the last lot, that time only I can avail the full amount of input as credit. So what about supplier? Supplier, if not paid the tax to department, can I reverse the credit? Wait. Supplier has a time period as per rule number 37A of the CGST rules, where he is eligible to pay the amount if not paid in time. The time limit available for the supplier is up to 30th September of the succeeding financial year. So not 30th November, my dear. 30th November is for the recipient to reverse the credit. If for the financial year, Raja, 25-26 financial year, for the year 25-26 financial year, I purchased some of the goods. That goods invoice issued by supplier, but unfortunate supplier not pay the tax to department. I avail ITC, no problem. Wait, do not reverse immediately. Time limit is there to supplier as per rule number 37 capital A. What is the time limit given to the supplier to pay tax to department is next financial year 26-27, 30th September 2026 time period is there. If by 30th September 2026 is not paid by supplier the tax amount, then the recipient should reverse the credit or pay the amount to department. Time limit for him, recipient, is 30th November of the succeeding financial year. If the supplier not paid the tax by 30th September of the succeeding financial year, the recipient should reverse the credit by 30th November of the succeeding financial year. Now got clarity? Any difficulty? However, payment to make within 180 days. if the goods purchase or receive the services on credit basis. Part amount paid by the buyer or recipient. Can avail part amount credit? Yes, part amount only reverse. Amendment is there. Now, sir, if the recipient being a distinct person, sir, oh, head office supply the goods to branch office at interstate level? Yes, sir. In that case, the recipient not required to make the payment to the supplier is deemed to be paid only. That means recipient can avail the ITC. This is what section 16(2) series. Coming to section 16, subsection 3, where capital goods comes into picture. When the capital goods comes into picture, my dear, the capital goods on which input tax credit you can avail only when you are not going to capitalize the GST along with your finished goods. Get my point, sir? If the GST capitalized along with the finished goods, the GST not qualify for input tax credit. This can be viewed in a simplified manner. In the following case, you can easily identify this in the given case, my dear. If you refer here, you can able to understand and assimilate it. Section 16, subsection 3, input tax credit on capital goods is allowed only when the GST portion of the capital goods do not capitalize. Sir, I capitalized it, sir, but not claim depreciation, sir. Oh, capitalized but not claim depreciation on the part of a GST. Very good. You are eligible to claim ITC or not? Yes, this point has been asked in the recent examination of CA final of September 25 examination. They said GST capitalized but not claim depreciation under section 32 of the Income Tax Act. Meaning what? Eligible to claim ITC is the way in which you can easily identify this capital goods concept. Is clear, sir? Coming to section 16, subsection 4. Time limit to avail the ITC. Time limit to avail the ITC. What is the time limit to avail ITC? 30th November of the succeeding financial year or a date of filing the annual return for the current financial year in the succeeding financial year. Whichever is earlier, within which you can claim what? Input tax credit. If you not claim, then you are declared to say that it is disqualify only debit to profit and loss account GST part. Is clear, my dear sir? And we too have section 16 subsection 4. 4 we covered, already covered. Then coming to this particular here itself, clarification is there, Amma. Sir, what about a case of reverse charge? Supplier unregistered person, Raja. Recipient is a registered person. Our same applies. Who should issue the invoice? As per section 31, subsection 3, clause F, the recipient should issue the invoice. Here, time limit has been prescribed. Time limit has been prescribed. What is the time limit prescribed here? Means within 30 days from the date of receipt of the goods associated to issue the invoice. Is clear? Is clear? If the invoice not issued, then pay the penalty. Pay the penalty. As per section 122. So later on issue the invoice, sir. Then that time, based on the invoice, can avail ITC? Yes. But pay the penalty. Is clear, my dear friends? These points are not clarified in the regular classes. Further, my dear sir, section 16, subsection 5, which is nothing but a particular, the past data. Past means 17-18 financial year, 18-19, 19-20, 20-21. For that period, input tax credit, if not availed in the time mentioned in 16, subsection 4, not claim the input tax credit, that time has been further extended. The extended is also over now. It now become a outdated section. Presently, we are far away from the place. So, section 16, subsection 6 has its own importance, my dear, to avail the ITC. Section 16, subsection 4 has its own identity. Section 16, subsection 6. What it talks about means, sir, your registration has been cancelled, sir. It may be run for 2 months, sir. 60 days under cancellation, under the registration is under cancellation. After that, you revoke the cancellation. In that case, can avail the ITSC? The law here says yes. Don't worry. You fulfill the conditions. Section 16, subsection 6 says that what conditions to be fulfilled here means, to claim this particular what we can call input task credit, which is not claimed as on the date of cancellation, and during the period of cancellation not claimed, not possible to claim. These invoices, input task credit can be claimed with the conditions. What conditions should be satisfied here means, the return what you not filed, now you are going to file, filled up to the 30th day of November of the following financial year, to which such invoice or debit note pertains, or furnish the relevant annual return whichever is earlier, meaning thereby a invoice belongs to 25-26. One invoice belongs to 25-26. Two invoices belongs to 24-25. For 24-25 invoices, maximum time limit as per 16.4 is 30th November of 2025 or annual return filing, whichever is earlier. 24-25 financial year, 2 invoices, credit not availed. 25-26 current financial year, invoices, 1 invoice not availed. Now 25-26 financial year, what happened? Today, 25th of November 2025, your registration got cancelled. As on the date of cancellation of registration, there are 3 invoices. Input has not claimed. 2 belongs to 24-25. 1 belongs to now, if you want to claim 25-26, registration got cancelled for 2 months. Let us say November month cancelled, December month cancelled, January 1st 2026 revoked, registration revoked, means granted registration back. If I want to claim invoices, input as credit of these 3 invoices, time limit should be mentioned. For the year 25-26, the year in which cancellation taking place, for which my time limit to claim invoices 30th November of the succeeding financial year, means 30th November 2026, or date of filing annual return 31st December 2026, for example. In that case, whichever is earlier, 30th November. As on 30th November, among the 3 invoices, only 1 invoice qualify for input tax credit. The 2 invoices of 24-25, time limit 30th November 2025, already over. You get my point, sir? Therefore disqualify. Only invoice can claim. Or otherwise, for the period from the date of cancellation of registration or the effective date of cancellation of registration, as the case may be, till the date of order of revocation of cancellation of registration, where such return is filed within 30 days from the date of revocation of the cancellation of the registration. That means, for example, in the case of November, December, for the 2 months period, cancellation period, there are 4 invoices which have not availed the ITC. That can be availed from the date of revocation of cancellation, within 30 days if I am going to file the return. So that date or the earlier date, 30th November succeeding financial year, or what we can call it, annual return filing, whichever is earlier, whichever is later, till the time I have the time limit. That means these 4 invoices during the cancellation period also I can claim input tax credit. If not claimed within 30 days from the date of revocation of cancellation, I can claim up to 30th November of the succeeding financial year. Means old invoices for which time period under section 16(4) is expired, that invoices you cannot get the benefit under section 16 subsection 6 is the meaning of it. Get my point, Amma? Any difficulty, my dear? Got the clarity? With that, section 16 packed up. Coming to section 17. Section 17, we have 17.1, 17.2, 17.3, which is proportionate reversal of input as credit, where it talks about as follows. Common credit on input goods, input services used for taxable as well as exempt output supplies, proportionate as per rule number 42 formula. Common credit on input goods, input services multiplied by exempt turnover divided by total turnover for the tax period. In that case, the common credit on input goods, input services attributable to exempt turnover, ITC not allowed. Get my point? Balance ITC is allowed. What about capital goods credit, sir? Capital goods is one step you have to take extra. Capital goods credit is considered allowed to claim. Commonly, you use the capital goods for taxable as well as exempt supply. Capital goods credit spread over a period of 5 years, namely 60 months. That credit divided by 60 months, per month credit will come. That credit multiplied with the exempted turnover divided by total turnover, you get proportionate attributable to exempt supply, that is not allowed ITC for every month. For how long period? For a period of 60 months. But I will ITC fully on the capital goods. Going on proportionally reverse the credit or pay the amount to department. Is clear, my dear friends? Coming to section 17, subsection 5, where blocked section 17.4 is there, na? Section 17, subsection 4, banking company NBFC. Banking company NBFC are considered, or they choose proportionate reversal, they can go ahead, or they go with plot common credit. 50% ITC is not allowed, balance 50% allowed. But interdepartmental transfers 100% credit allowed. Is clear? Whichever they feel economical, they follow, but should follow strictly all over India basis one method. Coming to section 17.5, blocked credit. Section 17, subsection 5, which refers to blocked credit. What do you mean by blocked credit? How to understand this is simplified manner presenting here for your kind consideration on the screen. Under the supervision, it is not a regular class, my dear. Supervision, I have covered the points to you, is a marathon. Blocked credit, when you considered here on the screen, if you refer, you come across by referring this. For example, if you have that four-wheelers or vehicle, passenger vehicle, seating capacity less than or equal to 13, where it is disqualified to claim ITC unless you have been used for specific cases where you are using this particular thing is for the purpose of further supply of taxable supply, or you are using for transportation of passengers, or you are using for what? Imparting training, motor skill, or otherwise if you are using this for further supply means renting or selling where taxable supply apply, then we will clarify ITC. Means what? Strictly speaks, passenger vehicle less than or equal to 13 capacity seating including driver, ITC is not allowed. Exceptions, ITC allowed. Get my point, sir? That and all. Furthermore, whereas in the given case on the screen it is not allowed because it is used for the personal, means their business purpose. No exceptional cases. Therefore, ITC is not allowed. In the given case of this motor vehicle, also ITC is not allowed because this has to be two-wheelers, 2% capacity only. Therefore, ITC is not allowed. Furthermore, if it is not a motor vehicle, not required to register in the Motor Vehicle Act, where the CC capacity of the vehicle is less than 25 cc, which is not exceeding 25 cc, it is two-wheeler not exceeding 25 cc. In that case, that is not a motor vehicle as per the Motor Vehicle Act, not required to register in the Motor Vehicle Act. Therefore, if I purchase this type of vehicle by payment of GST, I can avail ITC? Yes, IT is allowed. Is clear, sir? Similar to that, my dear, if I purchase a particular 60 seating capacity of a Volvo bus for pickup and drop of my employees using the course of furtherance of business, IT is allowed or not allowed? IT is allowed. Is an examination question already appeared in the examination. Get my point, sir? Further, my dear sir, Likewise, if you refer here, aircraft or vessel, passenger aircraft, passenger vessel, also it is allowed unless it is used for further supply, or unless used for what? For transportation of passengers, unless used for imparting navigating skills or flying skills, then it is allowed. Get my point, sir? And any services relating to vehicle, vessel, aircraft also in ITC not allowed. General insurance service, it is not allowed. Repairs and maintenance not allowed. However, it is allowed if I am a Sharma Travel, I purchase a passenger vehicle seating capacity 5 using for transportation of passengers where I am paying the GST 12%. Can I avail ITC if I purchase that goods vehicle? Yes. If I pay the insurance, if I pay the repairs and maintenance, if I pay the services, can I avail ITC? Yes. Get my point, sir? No, sir. My Sharma Travel, my name, I purchased the Maruti vehicles, 5 seating capacity, giving on rental basis, sir, where I am going to pay the GST 12%, sir. Can I avail ITC? Yes. I paid a general insurance premium. Can I avail ITC? Yes. No, sir. I am a practicing chartered accountant, cost accountant. I purchased BMW car, sir, by payment of GST. Can I avail ITC? No. Even if I take a rental basis, can I avail ITC? No. If I paid on my own vehicle, I paid general insurance. Can I avail ITC? No. Get my point, sir? If a general insurance company, national insurance company, giving the insurance to this vehicle, coverage, loss of stock, undergoing reinsurance, can I avail ITC? Yes. I am a manufacturer of a vehicle, can I avail ITC? Yes. Get my point, sir? These are exceptions. Once you cover this, furthermore, in the case of following services are disqualified, what are they? Food and beverages, outdoor catering, beauty treatment, health services, cosmetic plastic services, followed by the life insurance, health insurance services are disqualified from claiming ITC. However, if I am using this as the element of a composite supply or mixed supply, the principal supply or the main supply will attract the GST. Can I avail ITC? Yes. If I am providing similar type of services and I got services as input from a similar line of business, can I avail ITC? Yes. Is an obligation of the employer to provide to employee, can I avail ITC? Yes. Get my point, sir? Whereas these and all membership of a club or the health insurance, health services, fitness services, leave or home travel services are considered, ITC is allowed only if it is an obligation on the employer to provide to the employee. Otherwise, no. Similar enough business also no. Element of composite supply also no. It is a separate supply. If it is qualified, exemption, I mean to say, what to say, input as kit is qualified. Only when employer providing to employee under the obligation of a law. Otherwise, ITC blocked. Is clear of my difference? Not allowed ITC. Got the clarity? Any difficulty, my dear sir? Further, in the case of works contract services, works contract, yes. Loudly, ma? Yeah, you can have it. You can have it, Raja. Comfortably sit. Listen, my dear. Input as script. With regard to works contract service, what is works contract? Labor, material goes hand in hand. In that case, if it is in relation to plant and machinery, IT is allowed. What is not a plant and machinery? They said, one, civil structure, not a plant and machinery. This is not plant and machinery. Cell towers, not a plant and machinery. Laying the pipeline outside the factory premise, not a plant and machinery. If so, anything relating to plant and machinery, works contract service allowed as ITC. Anything not a plant and machinery, works contract services is not qualified for ITC. But works contract services, construction of an immovable property, it is allowed. Whereas works contract services in relation to repairs and maintenance of a building, ITC allowed or not allowed? Well allowed. The question has been asked in the exam of CA final, CMA final as follows. Also be asked in CA intermediate also. One can expect in the intermediate level also. A building where 2 lakh rupees incurred towards repairs and maintenance. Worst contract value 2 lakhs. GST thereon 18%, 36,000. This 36,000 plus 2 lakhs. This 2. This is debited to P&L account. Debited to P&L account. It is allowed, not allowed? Allowed. If you take 2 lakh rupees for P&L account, 36,000 you can take input as credit. The expenditure debit to P&L account is repairs and maintenance. If the expenditure is capitalized, then ITC there are not allowed. So works contract capital nature, works contract revenue nature. Works contract revenue nature qualify for ITC. Works contract for capital nature, ITC not allowed. Is clear? But if it's a plant and machinery, no problem. Is a capital in nature, ITC allowed. What is plant and machinery? They said by saying that anything appurtenant on the land, but does not include civil structure, cell towers, pipelines laid down outside the factory premises, is not a plant and machinery. Is clear, my dear friends? Thereafter, the construction services, where it has been received, construction services directly received, the labor services separately, material separately, and constructed the property. In that case, ITC also be not allowed. Got the clarity, my dear friends? A particular composition taxpayer eligible to claim ITC? No. A person, NRI, is eligible to claim ITC? No, except one case. Tell me anything. NRI can claim ITC only one case. Import of goods by payment of GST alone can claim ITC. Is clear, my dear? Further, my dear sir, anything social welfare activities, section 17 section 5 class FA, services CSR nature, corporate social responsibility purpose. If you incur the expenditure out of the fund, ITC not allowed. Blocked credit. If you use the things for your personal cases, ITC not allowed. Personal purpose ITC not allowed. If you purchase the goods which is before using the production, or you produce the goods before removed from the factory, got in the fire, thereby you have been written off in the books of accounts. That goods what you purchase, written off in the books of accounts. Are you eligible to claim ITC? No. ITC not allowed if the goods are stolen. ITC not allowed if the goods given as a free of cost. ITC not allowed if the goods are distributed as sales promotion. ITC not allowed if the goods for which you written off in the books of accounts, ITC not allowed. Get my point, sir? Thereafter, we do have a section called the section 17 subsection I, the last one. Very important section it is. In the case where the goods has been used, the goods has been what we can say, the goods supplied where against a particular show cause notice, clause I to section 17.5, section 129 detention and seizure, section 130 confiscation, section 74 capital A, where the notice has been issued, the taxpayer committed the fraud, therefore the demand has been raised, pay the tax. That payment of tax under section 74A or 129 or 130 of the CGST Act, the recipient cannot avail ITC. Got the clarity? With that, section 17 series has been packed up, followed by section 18. Section 18 I will take up, my dear friends. Right now, there are 6 subsections in section 18, where we have section 18 subsection 5 is only a particular directive rule to refer the rules, nothing else. Therefore, inviting the attention on directly 5 subsections only. Section 18 subsection 1 to section 18 subsection 6 by omitting section 18 subsection 5, which is only a directive rule. Section directing the rules to refer. 18.1, we have class A, class B, class C, class D. Class A, if you got registered compulsorily within a period of 30 days from the date of need arises, where you eligible to claim ITC only on inputs. If the inputs you are eligible to claim ITC, the invoices should not be older than 1 year from the date of invoice till the date of availing ITC. You are not eligible to claim ITC in the case where you are having the credit and capital goods. You are not eligible to claim ITC on input services, only on input goods. That too, the goods on which invoice should not be older than 1 year from the date of invoice till the date of availing ITC. Is clear? 18.1b, voluntarily got registered. In that case, the date on which you immediately present the date of obtaining certificate of registration, your raw material, the input goods only qualify for ITC, but not input goods, not input services, not in capital goods, only input goods. It may be lying on input goods in raw material form, work in progress form, or finished goods form, as the case may be, to claim ITC. But here also be invoice should not be older than 1 year from the date of invoice till the date of availing ITC, as referred in the section 18 subsection 2. Time limit is there. Coming to section 18 subsection 1 clause C, which talks about ceases to become a composition taxpayer. So far I am a composition taxpayer, but registered person only. So far composition taxpayer. But now switching over to regular scheme. Can I avail ITC? Yes. In that case, my dear, 18.1c says that ITC on input goods and as well as capital goods is allowed. Input goods immediately preceding the date of cessation of a composition tax nature, it is allowed. That invoices should not be older than 1 year from the date of invoice to the date of availing ITC. When we talk about capital goods, only thing is capital goods so far used for composition scheme. Now only you are going to use for regular scheme. Therefore, proportionate it at the rate of 5% per quarter. Part of the full quarter of the previous period where you have composition tax nature. For that period, you reduce the credit. The balance credit allowed for regular period on GST and capital goods, it is allowed proportionately. 5% concept. 5% per quarter for the previous period where you are under the composition scheme. That much you reduce. The balance credit only allowed. Is clear, my dear friends? Same way, section 18, subsection 1 clause D, which talks about what? 18.1D talks about 18.1D talks about a simple thing. You are so far under exempted supply, wholly exempted. Now it became a taxable. Now taxable means I can eligible to claim ITC from now? Yes. In that case, input goods credit allowed with the condition. Invoices should not be older than 1 year. Capital goods credit also allowed. Same manner. 5% per quarter. Part of the quarter's full quarter for the past period under the wholly exempted period. You remove balance credit and capital goods, it is allowed. Is clear, sir? But 18.1D, how differ from 18.1A? 18.1A, you now going for registration. 18.1D already registered, but wholly exempted. Get my points? Is the difference. 18 subsection 3, which talks about amalgamation, absorption, demerger, sale, the entire business, the transferor will eligible to claim ITC of the transferee. The what we can call the transferee is eligible to claim ITC of the transferor. Yes, transferor company or amalgamating companies. Input tax credit receivable will become a input tax receivable of the amalgamated company. Transferor input tax credit receivable will become a transferee input tax credit, because all assets and liabilities of the transferor will become the all assets and liabilities of the transferee. It is allowed. Here, time limit of 1 year not applicable. It's clear. Coming to 18.4, where the law says person opted to pay GST under section 10 means composition scheme, or the person whose supply wholly exempted. If so, from now they are not eligible to claim ITC. So refer first. What is the account of receivable available in the books? Input tax receivable. How much is there? Sir, 2 lakhs is there. How much stock is lying? Sir, 10 lakhs is there, sir. GST, there are 1.8 lakhs, sir. Okay. So 2 lakhs is receivable available, no? Reverse it, 1.8 lakhs. Balance excess, how much is there? 20 rupees. Will lapse. No, sir. Receivable is only 20,000, sir. Reversible 1 lakh 80, sir. Is it so? Reverse the 20,000. Balance 1 lakh 60. Shortfall. Pay the amount department. In case of capital goods credit is considered, bifurcate that life as 5 years. Capital goods credit is clear, Amma? So far used for how many months? Part of the month, full month. The balance credit for the exemption period or compulsion scheme. For example, 60 months. For 4.5 months, you use it for regular scheme. Now your compulsion scheme. So 4.5 months is also 5 months. Part of the month, full month. Out of 60, how much gone? 5. Balance is 55. So capital goods credit multiplied 55 by 60. How much amount comes? That amount is to be reverse the credit. How much is there to reverse the credit? Nothing is there to reverse the credit. Full amount to pay department. Is clear? Coming to section 18 subsection 6, where capital goods has been used, quite for some time for taxable supply, now disposing of as a second hand machinery. In that case, 5% per quarter, part of the quarter is a full quarter from the date of invoice till the date of disposal, apply on the capital goods credit, and that much you reduce. Balance credit, how much is there? That you compare with the GST payable on such capital goods. Whichever is higher is the amount to pay off on account of selling the second hand goods. Suppose if I am selling the second hand goods as a scrap, not second hand, uppo section 18 section 6 not applicable. Whatever duty payable on the scrap you pay off. It's clear? 18 is completed. Coming to section 19, which is nothing but a job worker. Section 19 talks about job worker. Section 19, job worker. If the goods sent by the principal to the job worker is input goods, ensure that after the process of job work, the goods should be come back to supplier, the principal, within a period of 1 year from the date of dispatch. In case of capital goods, the goods should come back within 3 years from the date of dispatch. If unable to come, apply to the commissioner for the want of extension. In the case of input goods, furthermore, 1 year can be extended. In the case of capital goods, furthermore, 2 years can be extended. Time period return back. If even after the expiry of the time period granted by the commissioner, if the goods not come back to principal, then the principal should pay the GST on such capital goods or on input goods sent for job worker, which is not returned at all. In that case, the principal should pay the GST. Time of supply will be go back to the old date when you remove the goods from the factory for job work. From that date till then you have to pay interest also, along with the payment of tax. Is clear, my dear friends? However, if the goods are jigs, fixtures, molds, dies, if these goods are sent for job work by principal, time limit of 1 year or 3 years not applicable. Even not returned also no problem, not liable to pay GST. Got the clarity, my dear friends? Is what? Capital goods or input goods in case of goods sent for job work. Is clear, my dear friends? Coming to section 20, Raja, is nothing but input service distributor. Input service distributor should distribute the credit as per the section 20 CGST Act. Should not distribute the credit to the unit which is not received the input services, and ensure that to distribute the credit only what is available for distribution. While distribute the credit to other state, CGST distribute as a IGST. Get my point, sir? For a distributor, registration of GST law is mandatory. If you distribute the kit more than what is to be distributed, as per section 21, it should be responsibility of the person who received the credit, we are not eligible to claim credit, should pay to department. If that recipient not paid the amount to department, the supplier ISD wala has to pay the tax. If not, as per section 21, the recovery takes place by invoking section 74A. Notice. Got the clarity? With this, section 16, 17, 18, 19, 20, 21 belongs to input task create chapter is completed. Is clear, my dear friends? Marathon with regard to input task kit is completed. Refined you now supervision or marathon with regard to TDS, tax deducted source. Section 51 of the CGST Act talks about TDS. My dear sir, in the given case, TDS deductors are registration mandatory. Section 24, clause 6 of the CGST Act mandate registration for them. Thereafter, they have to apply for application for registration form GST REG 07. Get my point, sir? And they should deduct wherever required deduct. Otherwise, they are punishable with the penalty. Who are here? There means one by one refer. The process of registration will refer to here. TDS registration. First step 1. Access the GST portal. Navigate to the GST portal to begin the registration process. Step 2. Select the TDS deductor menu from the GST portal. Choose the TDS deductors option to proceed with the specific registration type. Followed by step 3. Enter the details input necessary for registration along with the PAN number of the applicant, official name and contact details. Step 4. Where you should mention form GST REG 07 application for registration is a common for TDS and TCS, my dear. Step number 4. Upload the documents of the PAN number under whatever you given information. It should be supporting documents, scanned copy should upload. Thereafter, submit. Step 5. Submit with the DSC or EVC authentication. Submit the application using the digital signature certificate, DSC or otherwise electronic verification code which is coming to your registered mobile. For the step 6, registration process. The registration is processed and certificate will be issued in the form GST REG 06. Certificate remains same. Form GST REG 07 is application for registration for TDS and TCS. Form GST REG 06 certificate of registration. Once you obtained, then you are allowed to proceed further to supply the to date the TDS and date the payment and pay that amount to department. So here, for whom it is applicable, TDS for whom applicable and who are required to go for registration means step 1. Contract value taxable supply exceeds 2,50,000 exclusive of GST. Supplier should be registered person including person registered under the composition scheme. Step 2. The recipient should be DDO. Supplier if uninsured person Raja, TDS is not applicable even though the value is 3 lakh rupees. Get my point? First step, 2 points. What are they? The value of supply exceeds, taxable supply exceeds 2,50,000 exclusive of GST. And the supplier must be registered person. Step 2, 2 points. Recipient should be DDO. Now from 10th October 2024 onwards, the recipient, any registered person in case of metal scrap. In case of metal scrap, any registered person in case of metal scrap. Metal scrap also it is applicable now. Step 2, 2 points. What are they? Recipient should be DDO. Who is a DDO? Drawing and disbursement officer. Nothing but what a government company, government agencies, statutory bodies, or otherwise Society Registration Act or partnership firm, not partnership firm, the Society Registration Act, societies, government companies, local authorities, government agencies, statutory bodies. Thereafter, we can call as what we called public sector undertaking companies. We call them DDOs. Is there list? Big list is there, but not the partnership firm Raja. It should be government, central, state or unitary or local authority or a PSU or a government company or a statutory body or a society registered under the Societies Registration Act. You get my point, sir? Wait, my dear, I would like to say that anyhow, tiffin is coming for me. How many of them are there? 3, 6. I will call 2 it is okay na? Each one. Have it. I will sponsor, my dear, for my students. You are my strength. நாளைக்கு குவாலிஃபை ஆனப்பமேட்டிக்கு ரஃபி சார்னா யாருன்னு சொல்ல மாட்டீங்களே. ரஃபி சார் வந்து நாளைக்கு வந்து சென்ட்ரல் கவுன்சில் மெம்பர் நிற்கிறாரு, ஓட் போடுவீங்கல்ல. இதெல்லாத்துக்கும் லாலிபாப் இது. நான் நிற்க மாட்டேப்போ, சும்மா சொல்கிறேன். அவர் வந்து நல்லாயிருக்கும், எடுத்துகிட்ட ஃபோன் எடுத்தா. அவர் எடுக்க மாட்டேன். இவர் சரியான ஸ்ட்ரிஞ்சன்ட் பர்சன். சாருக்கு எப்படியாவது எடுத்து வந்து கொடுக்கணும் டிஃபின் போடுவார். அவர் வேறு எதையும் பார்க்க மாட்டார். சின்சியர் கை. ஓகே எட்ரா பாபு, நான் ஸ்ட்ரைக்கே ஆகலப்பா. சரி, நான் வர வைப்பேன். ஒட்டம் திரும்ப வரவர். Now listen back. Come back, please. So what I am referring to here is, sir, நான் சென்ட்ரல் கவுன்சில் மெம்பரோ கவுன்சில் மெம்பர் நிற்கவே மாட்டேன் சார். I am away from that. It is my students are my strength. That's all I can say. Whether you recollect me or not is your will and wish. But I always feel happy of meeting you people whenever you are in the helm of the affairs. I never going to ask to vote for me. I never going to contest also. It's very clear from my side. Just ஒரு ஃபன்காக சொன்னேன். நீ அது மனசில் ஏதிக்காதீங்க. நான் நிற்கிற மாதிரி எப்போ நிற்பேனே, இப்போ நிற்பேன். நான் எனக்கு வந்து ஃபார்மிங் தான் பிடிக்கும். ஃபார்மிங், கல்டிவேஷன், மை ஹாபி. That's it. Give the natural food. Now please come back. Who are the DDOs? Just now Refund. Tell me, government, central government, state government, unitary, local authority, government agency, statutory body, government company, PSUs. Is clear? Are societies registered under the Society Registration Act. But Society Registered Registration Act should be established by the government. Society registered in the Society Registration Act, which is established by whom? A government, like BCCI. BCCI society आया, तिरुमा Registration Society, Madras Society Registration Act, they registered. Government only established this society. So they are called DDOs. If not, a registered person who is dealing with what? Metal scrap. Sir, வாங்க இங்கே வச்சுருங்க. நம்ம பசங்களுக்கும் வந்து நான் சொல்ல வந்துட்டீங்களே, கொஞ்சம் தயவுசெய்து நம்ம ஹெல்ப் பண்ணுங்க. நான் பசங்க கூட சாப்பிட்டுக்கிறேன். 6 பிளேட் இட்லி. வேற என்ன எடுத்துக்கோங்க? தோசை 6 தோசை. பொங்கல் பொங்கல் 6 பொங்கல் எடுத்துக்கோ. ஏதோ ஐயா 6 பொங்கல்ஸ்னா 6 பொங்கல் இல்லை 3 பொங்கல் 3 தோசை அப்படிதான். 6 பொங்கல் + 6 தோசை கிடையாது. 6 வாணும். 6 பாயிண்ட். அது மிக்சிங் எதுனா பரவாயில்ல. இட்லினா பெஸ்ட்டு, இல்லைன்னா தோசை எல்லாமே தருவார். நான் ஒரு ஃபார்ம் பிளேஸ்க்கு போகிறேன். 1 ஏக்கர் லேண்டு 2க்கு எடுத்துகிட்டு ஃபார்மிங் பண்ணிகிட்டே இருக்கு. இப்போ பண்ண போகிறேன். அங்கே வந்து 2-3 நாய் வந்தது. மீன்ஸ் டாக். நம்மக்கிட்ட போன உடனே நம்மகிட்ட வந்துடும். கொடுப்பாங்க சாப்பிட்றதுக்கான. நான் சொன்னப்பா நெக்ஸ்ட் டைம் வரும்போது ஒரு பிஸ்கட் பேட் போட்டு கொடுப்பா சொன்னான். அதை சொன்னான். இப்போது பார்க்குற டிக்கில் நான் எவ்வளோ பண்ணி இந்த பெரிய பாக்ஸ் இருக்குது. என்னப்பா இன்னைக்கு கேட்டால் பெரிய பாக்ஸை வாங்கிட்டு வந்தாருப்பா. கடை போடுவாங்களே பாக்ஸு, கன்சிஸ்ட் ஆஃப் மேபி அதில் 50 பேக்கெட்டு 100 பேக்கெட் இருக்கும். பாக்ஸை வாங்கி போய் வச்சுக்காரு. ஐயா ஏதோ ஒன்று சொன்ன இந்த மாதிரி பண்ண புரியுதா? இப்போ பாரு என்ன சொல்றாரு, 6 தோசை + 6 பொங்கலாக கேட்குறாரு அவர். என்ன பண்ணுறது? பட் நைஸ் ஜென்டில்மேன். He is with me for the past 10 years. இந்த மாதிரி பண்ண தானே இருக்கும். But anyhow, gentleman. In a sense, single rupee not going to misappropriate. That gentleness is there. Honesty guide. Anyhow, please come back, my dear. So what I am referring here is TDS. Step 1 is what we referred here. Step 1 is what referred here. Step 1 referred what? The value should be exceeds taxable 2.5 lakhs and the supplier should be ratio percent. Step 2, the recipient should be DDO or if not a metal scrap dealer, ratio percent. Step 3, in case of intrastate supply, location of recipient must be located in the same state of supplier. In the case of intrastate supply, location of the recipient must be located in the same state of the supplier. ஒருவேளை intrastate supply amma and recipient is other state, TDS is not applicable. Intrastate பொறுத்தமட்டு be careful. Location of recipient should be in the same state of the supplier. Why you know? If the TDS deducted by the recipient and remitted department, it should be auto-populating in the electronic cash ledger of the supplier. If the recipient in other state, intrastate supply, location of supplier and the place of supplier in Tamil Nadu, recipient in Andhra Pradesh, he cannot deduct the TDS, not eligible for him to deduct TDS. If it's interstate supply, no problem. Interstate supply, recipient engane irkalam. Is clear? Interstate supply, recipient engane irkalam. Further, step 3 la first point enna sonna, intrastate supply, location of supplier and the intrastate supply, location of recipient must be in the same state of the supplier. One more point, in case of interstate supply, location of recipient may or may not be in the same state or of supplier. Step 4, TDS should be deducted at the time of payment or credited to the supplier. What do you mean this? Contract value 5 lakh Raja. Ana bill பண்ணது இப்போ 10,000 தான். Contract value taxable supply 5 lakhs. Bill பண்ண value how much? 10,000. 10,000 கொடுக்க போறேன் நான். 10,000 I'm going to pay. In that case, that 10,000 only will attract TDS. What rate? CGST 1%, SGST 1%, interstate supply 2%. These rate of TDS, examiner won't provide in the examination. You should recollect and apply. Recollect and apply. Purudamma. What rate of CGST, SGST, TDS? 1% is. CGST 1%, SGST. Effectively, interstate 2%. On what value? On the value of payment. Is clear? That's it. That's it. TDS is over. Any difficulty? Any difficulty? Now coming to the point of TCS. TCS, any difficulty? Any doubt, ask me. That's TCS, Raja. 0.25% CGST, 0.25%, just effectively 0.5% for what? Tax corrected source, section 52 of the CGST, not 51. Now I'm going to take up that. It's clear. So coming to this TCS under the GST. Sir, section 52 deals with this, sir. It is applicable only to e-commerce operator, sir, not to any other person. And that to e-commerce operator not going to be come under the section 9.5. 9.5 of the CGST where the e-commerce operator liable to pay GST himself. In that case, no TCS. The e-commerce operator not covered 9.5 of the CGST will cover TCS. Is clear? What rate of TCS will apply in the given case? Means 0.5% CGST, 0.5% GST in the case of intrastate supply. In the case of interstate supply, 0.5% IGST. On what value? On the total value which includes commission but excludes GST. Got the clarity, my dear? which includes commission, which excludes GST. Here there is no value limit, whatever may be the value. If I am a seller, my dear, my name is Titan, selling the goods through Amazon. I sold the goods for rupees 10,000, commission rupees 100. On what value apply GST, TCS on 10,000? If GST is there now, 18% GST is there now, 180 rupees. So 10,180, 1,800, yes, 10,000 means 18%, 1,800. So 11,800 is the total value of bill now. Eliminate 1,800, apply on 10,000, what rate? 0.25% CGST, 0.5% GST. But that 100 rupees is there in the 10,000 rupees, which includes commission, includes GST, excludes for taxing the TCS. Unlike of the TDS, there is no threshold limit. All e-commerce operators mandated registration TCS who are not covered under 9.5 is clear of application for registration form GST RG 07. Certificate of registration is form GST RG 06. Further, my dear, now the TDS wall are required to file the return form GSTR 7 by 10th of the following month. TCS wall also required to file the return form GSTR 8. Get my point, sir? Yes. Now coming to the point here. On what value will apply the TCS? Net value. What is the net value? Supply of goods or services less returns during that period. The balance net value positive. On that net value, positive value only TCS will apply. If the net value is negative, then no TCS will apply. Means returns more than supplies, then no TCS. TCS not applicable if the RCM applies. TCS not applicable if the RCM applies. Sir, what about 2 or more e-commerce operators are involved cases? Oh, 2 or more e-commerce operators are involved. That time, in that case, the law is again differently approached here. Look here. In the case where 2 or more e-commerce operators involved cases, e-commerce operator who himself, supplier side e-commerce operator, himself is not the supplier. He is the person liable to collect the TCS. If the supplier side e-commerce operator himself is a supplier, then buyer side e-commerce operator is liable for TCS. 2 or more e-commerce operator exist. A buyer placed the order to Flipkart. Flipkart wala tie up with Amazon. That goods has been fulfilled from Amazon. Now Amazon himself is Amazon product. Amazon is e-commerce operator selling his own product. So supplier side e-commerce operator himself is a supplier. Appo buyer side e-commerce operator liable for TCS. Suppose supplier side e-commerce operator himself is a supplier. A buyer placed the order to Flipkart, Raja. Flipkart wala tie up with the Amazon. Amazon is fulfilling order from his vendor, namely Titan. Now seller is a Titan. Seller is a Titan. Now seller side e-commerce operator Amazon. Amazon himself is a supplier. No. Seller side e-commerce operator himself not a supplier. In that case, who liable to collect TCS? Seller side e-commerce operator. Amazon product is available. Amazon product. If Amazon product is going to be supply, Amazon product, and screen. You will understand. Amazon products supplied by Amazon to the buyer through another e-commerce operator. In that case, buyer side e-commerce operator is the person liable for TCS. Suppose if the Amazon itself is not the supplier, seller side e-commerce operator himself is not a supplier, then who liable to collect the TCS? Seller side e-commerce operator. Get my point, sir? So here a product fulfilling through e-commerce operator. In that case, supplier side e-commerce operator is, if is himself is a supplier, supplier side e-commerce operator himself is a supplier, buyer side e-commerce operator liable for TCS. On the other hand, if supplier side e-commerce operator himself is not supplier, in the case who liable for TCS deduction? Seller side e-commerce operator. புரிஞ்சுக்கோங்க. Amazon has Amazon product. Is himself e-commerce operator. He is selling through Flipkart. Buyer side e-commerce operator Flipkart. They are liable for TCS. Amazon selling not their own product, the product of the other vendors. There are two e-commerce operators, Flipkart and Amazon. In that case, buyer side e-commerce operator liable for TCS or seller side e-commerce operator liable to collect TCS? Seller side e-commerce operator, because seller side e-commerce operator himself is not a seller. Get my point, sir? That's it. TCS completed. Next what, my dear? Now refer to my dear sir. Refund under the GST section 54 deals with this, where we have section 54 section 3 clause A, zero rated supply, where export of goods, export of services, you can able to choose as per section 16 of the IGST Act, zero rated supply. Supply the goods under LUT without payment of GST is called zero rated supply. In that case, the input tax credit on input goods, input tax credit on input services proportionately attributable to the export of goods turnover, export of services turnover, you can claim the refund. But you cannot claim the refund on input tax credit on capital goods. Capital goods never going to qualify refund. Sir, I want to claim refund on capital goods also, sir. Is it so? In that case, hey, Mr. Exporter, you export the goods by payment of dash IGST. The same you can claim for refund. Is clear, my dear friends? Refund claim should be made within 2 years from the relevant date. If time barred claim, refund not allowed. What is the formula has been mentioned? Export of goods under LUT without payment of IGST, namely zero supply, means the formula here given here as follows: net input tax credit, which includes input goods, input services credit for the relevant period, multiply with export turnover of goods plus services for the relevant period, divided by total adjusted turnover. Get my point, sir? Now, here exempted turnover should not include in the total adjusted turnover. Exempt turnover should eliminate it. Is clear, my dear? Opening balance credit, which is carrying forward the previous tax period, should not be considered for the formula. Is clear as? When you talk about inverted duty structure credit, where section 54 subsection 3, read with rule number 89 sub number 5, there is a lengthy formula based refund claim which is also easy to identify and understand. Inverted duty structure means input goods higher rate of GST, after manufacture when I clearing that goods into domestic area with a lesser rate of duty. My raw material A 18% GST, raw material B 12% GST. But when a manufactured finished goods produce only 5% GST, then thereby I have excess credit with me all the time. Can I claim refund? Yes. That is only on input goods, not even input services. Refund claim under the inverted duty structure as per section 54 subsection 3 clause 2. Read with rule number 89 sub number 5 is equal to maximum amount of refund is equal to turnover of inverted duty rate supply of goods services multiplied by net credit divided by adjusted turnover. Simple, my dear. Net credit, what is net credit? Only input goods credit. That you multiply with inverted tax turnover divided by total adjusted turnover. From that derived value called A minus net credit, again input tax credit or input goods, that you multiply with tax payable on the inverted duty structure turnover divided by ITC availed on input services. That value derived as a B. So A minus B greater than 0, that amount only refund. That amount only refund. A simple illustration here for making you understand as follows. If you refer here, there is an example. Take into account. Even that live example I will show you. Take into account. Raw material I purchase. My name is X Limited. I am a manufacturer. I have purchased the raw material at the rate of 18% GST. Input goods 18% GST A. I too receive spare parts, consumables, debit to profit and loss account. Inputs includes consumables, stores, debit into P&L account. So ask my raw material, which is also 18%. Input services are there, 20,000. With that I produce the finished goods where 5% GST. 5% GST finished goods are there, which is 25,000 finished goods supplied. I too supplied 18% GST goods, which is 45,000. Total turnover 25 plus 45, 70,000. Is clear? Total turnover is the 25,000 plus 45,000 equal to how much? It comes to almost all, how much come? 70,000. Is clear, my dear? Now, when we refer in the given on the screen, you come across this. Raw material A 18% GST, stores 18% GST. My finished goods 5% GST, other finished goods 18% GST. So inverted turnover is only 5%, not 18%, which is 5 lakh rupees worth of the goods I produce. On 5 lakhs 5% GST, 25,000. Not 25,000 is the turnover, 5 lakhs is the turnover, 5% GST. On which GST 5%, 25,000. Taxable goods I produce 18% GST, but value of the goods is almost all, it is 2.5 lakhs. Not the 45,000. 45,000 is GST on 2.5 lakhs, 80% GST, 45,000. Is clear? Now, from the given story, you have 3 elements of inputs. 18% in raw material A, where the GST you paid is rupees 48,000. Input services, tax paid thereon 20,000, input as credit. Stores consumables, 18% GST, GST paid thereon is 12,000. Is clear? 48,000 raw material, 18%, stores 18%, 12,000. So 48,000 plus 12,000 equal to 60,000 is my input tax credit on input goods. But do not add 20,000 services tax as input services, and that GST should not be added here. Net credit is only input goods, 60,000. Finished goods, 5% GST, 5 lakh rupees. GST 25,000 is inverted turnover. 2.5 lakhs, 18% GST. GST thereon 18%, 2.5 lakhs into 18% equal to 45,000 is a GST. That is the inward turnover. Now in the given case, total turnover 2.5 lakhs plus 4.5 lakhs plus 2.5 equal to 7.5 lakhs total turnover. Is clear? Now net credit how much is arrived? 60,000. Multiply with inverted turnover only 5 lakhs divided by total turnover how much? 5 lakhs plus 2.5 lakhs, 7.5 lakhs. How much you get? 60,000 multiplied by 5 lakhs inverted turnover divided by total turnover, 7.5 lakhs equal to how much? 20? 20,000 got? Check it out. 60 input tax credit how much? 60,000 net credit on input goods multiply with inverted turnover 5 lakhs divided by total turnover 7.5 lakhs. How much comes? 40,000 is a derived as A. A how much? 40,000. Now find the B. B. Tax on inverted turnover how much? 5 lakhs into 5%. 25,000. That multiplied by net credit how much? 60,000 divided by credit on input goods and input services, which is 48,000 plus 12,000, 60,000 plus input service credit 20,000, totally 80,000. So tax on inverted turnover 5% of 5 lakhs 25,000 multiplied by net credit and input goods 60,000 divided by total credit and input goods input services is 60,000. How much comes to B? 18,750. So A you already got 40,000 minus B 18,750. Excess surplus A minus B greater than 0. How much is there? 21,250 is a refund. Is clear? In the given case as per the formula. But my dear, when you derive the rule number 89 sub rule number 3 or 89 sub rule number 4, 89 sub rule number 5 as the case may be, that means it may be as per the formula, namely in the given case, in the given rule number 89 sub rule number 4 formula or rule number 89 sub rule number 5 inward structure, whatever may be, the refund is subject to the following parameters. Refund as per rule number 89.4 or rule number 89.5. 89.4 formula for export and a zero supply. 89.5 inverted structure. As the case may be, that refund amount is after comparing with the other values. What are the other values? Listen. At the time of making the application for refund, how much credit is available? How much? As a receivable in our books, electronic credit ledger. That value. Second case, after filing the return GST 3B for the given tax paid for which you are asking for refund, after filing the GST 3B return, leftover credit available as a receivable credit, how much? Further, you considered, hello brother, hello, not this classroom, please check. And tell your friends not to come here. No problem, sir. Thank you. Now listen, my dear. Refund is on base summa. Rule number 89, sub number 4. Export under LUT without payment of GST. Formula net credit multiplied by export turnover divided by total turnover. Is clear? That total turnover should not include export turnover. Is clear? That refund amount or inverted structure refund. Rule number 89, sub number 5. Formula inverted tax turnover multiplied by net credit divided by total turnover minus tax on inverted turnover multiplied by net credit divided by total credit of input goods, input services. If it is A minus B greater than 0, this will become refund, that amount. These refund amounts compare with two other factors. What are the two other factors? At the time of making the application, the credit available in the return credit ledger. For the tax period for which you can refund, for that tax period you file the return GST. After file the return, leftover credit in the return credit ledger, that values. These values compare with the refund values as per formula base. Among the three, whichever is less is the refund claim will be allowed to you. Is clear? Now here one step ahead I am going and explain to you. In the case of rule number 89, sub rule number 4, when you export the goods under LUT without payment of GST and namely zero supply, your export turnover numerator should be FOB value of export compared with the invoice value. Whichever is lesser value should take. For numerator, formula, tell me. Rule number 89.4 formula. Rule number 89.4 formula. Export turnover divided by total turnover multiplied by net credit. That export turnover, well, you choose the value, it should be FOB value of export or export invoice value, whichever is less. Means FOB value shown in the shipping bill. FOB value shown in the shipping bill or invoice value, export invoice value, whichever is less. Is clear? That is called export turnover. That turnover should not take as such. Again, compare that FOB value or invoice whichever is less, chosen as a export turnover. That export turnover should be compared with 1.5 times of similar goods supplied into DTA. And that value or this FOB value or this export value, whichever is less, finally you choose as a export turnover. Meaning, numeric example. FOB value shown in the shipping bill 10 lakhs. Invoice value is 8 lakhs. Which one should we choose? 8 lakhs. That is export turnover compared with 1.5 times of similar goods supplied into DTA. Similar goods supplied in DTA is a 5 lakhs. 5 lakhs in 1.5 times? How much? 7.5 lakhs. 8 lakhs and 7.5 lakhs, which is less? 7.5 lakhs is finally you take as a your export turnover in the formula. Only for rule number 89, sub number 4. Got the clarity? And the refund should be claimed application made RFD01 application for refund should be made within 2 years from the relevant date. You get my point, sir? Refund can be claimed based on the export, based on the provisional assessment become finalized with excess payment, as the case may be. The department has the time to pay in case of export. In case of export, physical exports taking place, immediately they will pay to you 90% of the value. The balance will be in due course, 10%. In the case of other than this case, 6 months time period they will take to refund to you without interest. If the delay happen, 6 months, not 6 months, 60 days time period, sorry to say. The department will take maximum, how much time period? 60 days. But in the case of export, physical exports, export outside India, they have to refund to you immediately. Get my point, sir? 90% they will give when you made application. Balance 10% only they will give in due course of 60 days. In all other cases, time period to grant the refund is 60 days. If the delay happen, the department will pay to you at the rate of 6% interest per annum thereon. Is clear, my dear friends? In the case of export of services considered, if I got an export order of $1 lakh, but I fulfill the export $60,000, for the $40,000 I have been outsourced to some other company outside India, that will be treated as import of services for me. In that case, what is my export order? $1 lakh, $60,000, $1 lakh is the clarification of the C base is available with us. It's clear, my dear friends. The major core area, hot core area of the refund have been covered in the marathon class in your super revision class. Is clear? Now referring to you penalties, offences and penalties, section 122 to section 138. a bigger chapter it is at final level of CA, CMA. Now I'm referring to in the name of marathon, super revision. Section 122 has, subsection 1 has so many subclasses which are offences. Registration required but not registered. You issue the invoice but not issue the supply of goods. Or issue the goods but not issue the invoices. These are all offences. For all these offences, penalty is available, sir, which is nothing but 100% of the tax amount or rupees 10,000, whichever is higher as per the CGST. Equal amount as per the SGST. Further, section 122, subsection 1, capital A, offences committed by a third person, kingpin, mastermind. He also be liable for this particular penalty of 100% of the tax or 10,000 rupees, whichever is higher. What offences are there involved here? Goods has been supplied without issue of invoices, or issue the false invoices, issue the invoices without supply of the goods, or take or utilize the input tax credit and thereby causing the revenue losses, or take or distribute the input tax credit by inputs of distributor where the taxpayer committed the offences upon the directions of a mastermind. On mastermind, this penalty will be levied, which is nothing but 100% of the tax amount is the penalty. 100% of the tax amount is the penalty. Is clear, my dear sir? Further, section 122 1B. 1B is a new provision introduced from 1st October 2023, which talks about a e-commerce operator. You are aware of it? Liable for collection of TCS if not collected penalty. TCS tax collected, who will collect a e-commerce operator? Now, e-commerce operator allowed to permit to supply the goods of an unregistered person. If the unregistered person is supplying the goods through e-commerce operator, intrastate supply, allowed? Allowed. But that unregistered person should get a unique identification number and give to the particular e-commerce operator. E-commerce operator, when reporting GST or 8 return on monthly basis, should report these transactions. On account of failure to do so, liable for penalty. Penalty here is equal to how much? Again, 100% of the tax amount on that particular person liable to pay penalty. 100% of the tax amount. Section 122, subsection 1, capital B, or rupees 10,000, whichever is higher. 100% of tax amount or rupees 10,000, whichever is higher. Is clear, my dear friends? Thereafter, referring to here, section 122, capital A, new section has been introduced from 1st October 2024. Section 122, capital A. What this is talks about here is certain machineries meant for manufacturing of pan masala and all, sin goods. Those machineries, you must be registered machinery wise. If not registered within the time specified, the penalty up to rupees 1 lakh per machine that have to be paid within 3 days from the date of him passing the order. If not, that goods are liable for confiscation. Get my point, sir? Penalty 1 lakh per machine. Further, my dear sir, in case of section 122 subsection 3, a penalty called general penalty up to rupees 25,000 for any offences, which is not a general penalty, it is called as is a penalty on the mastermind. In addition to section 122 subsection 1 capital A, 100% of the tax amount plus penalty 122 subsection 3 up to rupees 25,000 as per the CGST or the equal amount as SGST also will levied in the given case on the mastermind. Section 122 subsection penalty on the mastermind. Further, my dear friends, section 123 penalty. What do you mean this? furnishing the information written where the information called for not given by the concerned party. In that case, penalty will be levied 100 rupees per day of delay or rupees 5,000, whichever is less. Information report called from any other person. Further, failure to furnish statistical report by any person, including auditor. If not able to furnish the statistical report, section 124 talks about penalty. First day of delay 10,000, balance number of days delay per day 100 rupees. The total value should not exceed rupees 25,000. That means 10,000 per first day plus 100 rupees per day of delay or rupees 25,000, whichever is less, is the maximum penalty as per the CGST. Equal amount of penalty as per the SGST. So maximum penalty how much? 50,000 will be levied. General penalty, section 125, which talks about up to rupees 25 rupees CGST for general penalty where there is no specific penalty has been imposed. Section 126 talks about nothing but what? It is nothing but it is a penalty. What we call, is it a minor breach, therefore waive the penalty, or is a penalty livable for the any offences? Specifically, there is no penalty prescribed. That penalty will come under 126. What is the amount of penalty? As per CGST, 25,000 maximum. SGST, 25,000 rupees. Maximum, 50,000 rupees. Such a penalty can be imposed under section 106 if there is no specific penalty is there for any other offences for you. A penalty is, for example, Raja, there is a falsifies the record, maybe intentional or unintentional. If so, there is no specific penalty provision has been prescribed for the given particular offence. In that case, 126 says that I will levy the penalty if it is not a minor breach. What is a minor breach? If the value involved, tax amount less than rupees 5,000 or the easily identifiable from the records, easily rectifiable in the records. In that case, minor breach. If minor breach, no penalty. Penalty will be waived. Sir, not a minor breach, sir. More than rupees 5,000 rupees involved, sir. Or equal to rupees 5,000 rupees, sir. Not minor breach, sir. If not a minor breach, that offence has been disclosed by the supplier, the person who committed this offence, before detecting it by the department. Yes, sir. In that case, such breaches can be mitigatable. That means can be reduced or waived. One is minor breach. What is the minor breach? Less than rupees 5,000 tax involved or easily identifiable. If not a minor breach, the breach is informed by to department before department detecting is yes, sir. In that case, that can be mitigatable. That means can be waived and say that next time do not do this. Is clear? Section 126. Further, my dear friends, referring to here, important provision, section 128 is old provision, means outdated provision, not there now. 129, detention and seizure of the goods. Detention and seizure of the goods, relevant from the exam point of view. Section 129, where during the transit, if you not carry the relevant documents were required for e-way bill more than rupees 50,000 value of taxable goods supplied, interest supply, e-way bill required. In the case of job worker, in the case of a handicrafted goods which is exempted, if it's supplied, interest supply, irrespective of the value of the goods, e-way bill required. So e-way bill required not carried out, or defective e-way bills, or invoice required but not there. In all these cases, the goods can be detained during transit and levy the penalty. In that case, that penalty is, in the case of taxable goods, owner come forward 200% of the tax amount. If the owner does not come out to pay this, where the department is declaring a deemed owner, in that case, penalty is equal to, for taxable goods, value 50% is the value of the goods or 200% of the tax amount, whichever is higher. In the case of exempted goods, penalty under 129 is equal to, owner come forward to pay the penalties. In that case, 2% of the value of the goods or rupees 25,000, whichever is less as per CGST. Equal amount as per the SGST also. In the case of owner not come forward, the department declared some other person as a deemed owner. That time the person On deemed owner, the penalty in the case of exempted goods are considered 129 penalty is equal to 5% of value of the goods or rupees 25, whichever is less, as per CGST, equivalent as per the SGST. Got the clarity, my dear? Any difficulty, Amma? Further, coming to section here, what is the penalty on the conveyance? Means vehicle owner whose vehicle also detained and seized. To release the conveyance, the penalty is penalty leviable as per section 129 or rupees 1 lakh, whichever is less. So maximum penalty in the conveyance owner 1 lakh. Is clear, my dear friends? Further, referring to here section 130. 130 refers what? Confiscation of the goods. Section 130 refers as a confiscation of the goods. If the goods are confiscated, ownership of the goods will be shifted from the owner to the department. In that case, to leave or to release confiscated goods, a fine in lieu of confiscation will be proposed by the department officer. If it is so, penalty, the fine is equal to, the maximum fine is equal to the market value of the goods less tax payable thereon is the maximum value. Minimum value 100% of the tax amount is the fine that has to pay within a period of 3 months. If not paid, the goods are liable for auction to sell. What is the penalty under, what is the fine under section 130? Section 130, fine. Confiscation, a fine in lieu of confiscation on the owner of the conveyance. 100% of the tax amount is the fine, maximum fine. Now, this fine should be paid within 3 months from the passing order. What about section 129 penalty should pay within 15 days from the date of passing the order. Get pay person is there. Section 129, time period to pay. Time period to pay is here they mentioned by saying that within 15 days by passing the order. To pass the order, there must be show cause notice. Within 7 days of the detention, seizure, show cause notice. After 7 days, by taking 7 days time, issue the order. Within 14 days, pass the order from date of detention. Thereafter, from the date of passing the order, within 15 days, you have to pay the amount. If not, the seizure goods liable for auction. Is clear, Ammajas? Section 130 covered here. Then furthermore, moving on to section 132. When we talk about 132, it belongs to the provision of a prosecution, offense, bailable, non-bailable, arrest. If arrested person is confiscated, then imprisonment will come. In that case, directly I am looking here. Section 132, subsection 2, class. Section 132, subsection 1, class A, class B, class C, class D offences. Class A. What is class A here refers here? Class A refers to goods supplied, services supplied without issue of invoices. Class B, issue the invoices without supply of the goods services. Class C, availing the input tax kit, utilize the input tax kit based on the fake invoices as per class B. Class D, tax collected but not paid for a period more than 3 months from the due date. In all these cases, the offences exceed 500 lakhs, namely 5 crores of tax involved, total tax, GST total tax, more than 5 crores, then that offences are cognizable, not bailable. Actual person cannot get the bail. If offence proved, maximum period of 5 years imprisonment. Is clear, my dear friends? All other offences is bailable, namely non-cognizable offences. Actual person asks for bail. Bail should be granted. Offence has been proved. In that case, depends upon the tax evasion. 100 lakhs, namely 1 crore, or is more than 1 crore, depends upon the values that particular. Minimum there must be more than 1 crore offence, more than 1 crore rupee offence, but not exceeding rupees 200 lakhs, more than 1 crore, less than or equal to 2 crores. That offence taken place, bailable offence, non-cognizable. If offence proved, imprisonment maximum of 1 year. If it is more than 200 lakhs, namely 2 crores, but not exceeding 500 lakhs, namely 5 crores, in that case, also that offence is non-cognizable, bailable. If offence proved, imprisonment up to 3 years. More than 1 crore, less than equal to 2 crores. Offence proved, 1 year imprisonment. In addition to fine. More than 2 crores offence, but not exceeding 5 crores offence, tax evasion, bailable only. If offence proved, imprisonment up to 3 years with the fine. If it is more than 500 lakhs, namely more than 5 crores of tax evasion, where it is other than class A, class B, class C, class D of section 131, in that case, that offence is again bailable, namely non-cognizable. If it is that class A, class B, class C, class D offence of section 131, more than 5 crores of tax evasion, even arrested person cannot ask for bail, is a cognizable offence. If offence proved, whatever may be the offence proved, tax evasion more than 5 crores, maximum imprisonment is 5 years. Second time you committed any offences, irrespective of the value of tax involved, is a cognizable, non-bailable. Maximum imprisonment 5 years. If offence has been proved. Is it clear? In the case of falsifying the records, offences are considered irrespective of the value. If the offence has been proved, imprisonment is there. Minimum is 6 months, is the maximum. 6 months offences with regard to falsifying the records. Is clear? Thereafter, power to arrest is there with the commissioner only. Section 69, arresting power is with whom? Commissioner of Central Tax. Section 70 is nothing but the power to issue summons. The summons received person should come present physically by himself or his representative, as the case may be. Thereafter, was section 133, liability of the officers of the department. If they commit, they also be punishable with the imprisonment if the offence proved for a maximum period of 6 months. But arresting to them, requirement of a approval from the government, because government employees, department people. Is clear, my dear friends? For others, commissioner should grant the permission to arrest the person. Section 135, presumption of culpable mental state is meaning what? Department issue the notice and pass the order means offence committed by the taxpayer. The prima facie court will accept. It is up to the defender to defend. No, so not committed guilty, show the proof, satisfy the court. Court will pass the order in favor of it. Otherwise, the culpable mental state will remain state. So all offences where the department impose the offence, court will consider this as such. It is up to the taxpayer or his representative to prove it. They are not committed guilty. Section 136, relevancy of statement under certain circumstances. What is the relevancy? If anybody given the complaint on any person, anybody given the complaint on the any person, it should be proved by the complaint person who given the complaint how he is relevant. If that complaint person is disappears, unsound mind, somebody hide him, kidnapped him, or passed away, in that cases the statement given by him will be whole good. Otherwise, he should come and present and give explanation. Then only will be relevant. Further, my dear friends, offenses by companies, directors of the company responsible. To the person who committed this offense as in charge of the company, who is signing the records of the GST, is responsible. Coming to the compounding of offense. Section 138, compounding. A taxpayer should apply to the compounding authority commissioner for compounding the offense, and the commissioner will refer the matter to the junior officer, named the assistant commissioner, deputy commissioner, or joint commissioner, assistant commissioners, whether shall compound offense or not. Depends upon the report given by the junior to the commissioner. Commissioner will consider to compound. If we consider to compound, the amount mentioned in the compounding amount to pay should be paid within a period of 90 days of the within a period of 30 days from the date of passing the order. Compounding of offense will be passed by the officer if they are relevant to pass within a period of 90 days from the date of receipt of the application. Within a period of 90 days from the date of receipt of the application, they pass the order. Is clear, my dear? And you have to pay within 30 days from the date of passing the order, the compounding amount. Then only is a compounding. That means the file closed once for all. There won't be any furthermore inquiry against you. You get my points? Compounding offense, quick relaxation. This compounding possible at the time of a show cause notice, order passed, or the court taken up for hearing before judgment. Once the order of court has been issued, you cannot go for compounding. Compounding not possible second time, third time. Compounding also be not possible a case where if the value here they mentioned, very clearly they mentioned by saying that compounding not allowed cases are there. A person who has been allowed to compound once, second time not allowed. Thereafter, a person who has been accused, means committed offense, accused committing an offense under particular section 132, section 1, class B. What is class B? Issue of invoices without supply of goods or services. That can be compounding because there is no offense. You get my point, sir? Section 132, subsection 1, class B is not taken up for offense, Raja. Reason you know? Why not taken up for offense? To punish with the imprisonment means the value of tax involvement 0. I wrongly availed, amma. Why should I say that? First of all, not a supply, ma. Issue the invoice without supply of the goods services, supply. But how can you issue the invoice? Offense. Offense punishable under 122, where 100% of the tax or rupees 10,000, whichever is higher. But not a supply. Circular is there. CBI circular. Issue the invoice without supply of the goods services. Not a supply. Not a supply. No GST. No GST. No offense. Punishable with imprisonment. No compounding of offense. Is clear? The punishable with the penalty under 122. Subsection 1. Issue of invoice without supply of goods services. Tax amount 100% or 10,000, whichever is higher. That's all. Thereafter, here, a person who has been convicted, means offense proved, then cannot be go for compounding of offense. This question has been asked in the examination. Any other class of persons or offences as may be prescribed by department, government upon the recommendation of GST Council. Meaning thereby, in the 4 cases, compounding not allowed. Second time not allowed. First point, second time not allowed. Thereafter, 132, subsection 1, class B offences, no compounding. Thereafter, the person got convicted in the court, no compounding. Fourth one, any person has been notified by the government upon the recommendation of the GST Council, compounding not allowed. Is clear? Here, minimum compounding amount 25% of the tax amount, maximum is 100% of the tax amount. In between, they have given some slabs where the offences belongs to a category called as section 132, section 1, clause A, class C, class D, or class E. Any offence other than the class A, B, C, and D. That offences where the value is more than 500 lakhs tax evasion, minimum is 60% or 50%, maximum here is 75%. Minimum is 50%, maximum is 75%. In the case less than or equal to 500 lakhs of tax evasion of section 131, class A, class C, class D and class C, in that cases minimum 40%, maximum 60% of the tax amount is the what we can call the compounding amount. If it is other than these cases, 25% minimum, maximum go up to 100%. If two or more offences are involved, 25% or 40% that comes into picture, 40% we select. A problem we did in the class. Got the clarity? With this, penalties, offense penalties at your level, super fast revision, namely marathon, is completed. Namaste, my dear friends. Referring to you now, Foreign Trade Policy 2023. A new foreign policy, it is none other than advanced concept of customs law. It deals with export promotions for exporters to encourage the exports. Under the FTP, Director General of Foreign Trade, DGFT, plays vital role, without which the foreign trade policy is not possible to function. Like no CBIC for our indirect tax laws, for the foreign trade policy, DGFT is like that. It's clear. Now, it talks about export promotion schemes. If you export the goods, what benefits you will get? What type of benefits you get for an exporter? And moreover, my dear, foreign trade policy generally emphasizing make in India, local to global concept, make in India and export from India. Then you are the earner of the foreign currency, where we appreciate your performance and we will give the incentives to you. Those incentives, now I am going to refer here one by one. And before going for that, special economic zone located in India, which is called as separate island within the territory of India, is, though may be located physically in India, technically outside India. You get my point, sir. The special economic zone incentives are absolutely not covered under the foreign trade policy. Reason, special economic zones coming under the separate Special Economic Zone Act and rules, which is governing under the Union Ministry of Finance, whereas our foreign trade policy is governing under the, especially as you are aware of it, it is Union Commerce and Industry Ministry. You get my point, sir. Commerce and Industry Ministry is governing the FTP, where the DGFT is the mentor for us. The entire foreign trade policy talks about the export incentives. What are those export incentives? I am referring here one by one is as follows. The export incentives for the foreign trade policy are as follows. Here, one by one I am presenting for your kind consideration. If you refer here, my dear sir, in the slide, you come across first and foremost the duty exemption schemes. Under that, we have two schemes. One is called as Advance Authorization Scheme, and another one is called as Duty Free Import Authorization Scheme. On the other hand, one more scheme is called as Duty Remission Scheme, which is none other than duty drawback schemes, are followed by remission of duties and taxes on exported products, RODTPs, namely remission of duties and taxes on exported products. A new scheme it is for the exporters. Further, we too have EPCG scheme, Export Promotion Capital Goods Scheme, which is allowed to import capital goods without payment of import duty, ensuring that you have to fulfill the export obligation. then you are not required to pay import duty on such capital goods. Further, one more point is there known as EOUs, EHTPs, BTP schemes followed by deemed export. As we understood, section 147 of the CGST Act, deemed export meaning thereby before export supply the goods. A manufacturer in India supporting manufacturer, that type of transaction we used to call as a deemed export. Now I explain to you all the points one by one is as follows. Referring what? Foreign trade policy. It talks about what? Only export promotion schemes. Otherwise nothing. If there is no export promotions, no foreign trade policy. Foreign trade policy is regulating export imports by encouraging our exporters to meet the objective of A minus B greater than 0. What is our A? A is nothing but export. B is our import. At the end of the day, A minus B greater than 0. That means our foreign earnings should be more than our foreign spendings. Is the meaning of it. Is the main motto of a foreign trade policy, for which we are not going to violate the international trade practices. By honoring the international trade practices, we are adopted a new foreign trade policy in the year 2023, which is continuing now. If required, upon the recommendation of the DGFT, the Union Commerce Industry Ministry is going to be monitor and updating, amending. Depends upon the recommendations from the industry and all. It's clear, my dear friends. In this process, the first and foremost export exemption scheme I am referring, another there are two exemptions schemes, means duty exemptions, namely what we can call it as export promotion schemes. First one, duty exemption schemes consist of two things. What are they? I refer to you. What are they? One is called as duty advance authorization scheme. Under the duty exemption scheme, first one is called what? Advance authorization scheme. AA we used to call it. Second one is called as duty free import authorization scheme. DFIA scheme. DFIA, duty free import authorization scheme. Now what is the advance authorization? I will brief you before explaining this content. My dear sir, when I import the goods, I have to pay import duty or not? Why should I pay import duty? Because I import the goods only for the purpose of manufacture and export. After manufacture, I am going to export. I am an exporter. I am an export house. I am a manufacturer come exporter. I am a star exporter. Then who is a star exporter? Star exporter means we have a category here. Star exporters are none other than if they perform the export performance like $3 million and above of exports for the past 2 years, well, we can say for the past 3 years plus current year. During the current year and past 3 years. So year 1, year 2, year 3, previous 3 years, accumulate our exports, including deemed exports, plus current year as of today. Today what date? For example, today date is what? 25th of November 2025. If so, as of today, which financial year it is? 25, 26. So preceding 3 financial years, add, don't average, add it, and current financial year, all our export plus deemed exports. How much your export turnover as of now? $3 million and above. You know 1 million equal to 10 lakhs. $3 million and above, but not exceeded $15 million and above. In that case, 1-star export. If it is $15 million and above, but not exceeding, not touching $50 and above, in that case, 2-star export. 2-star export house. If it is $50 million and above, but not touching $200 million, in that case, 3-star. If you exceeding are equal to $200 million and above, but not exceeding, not touching even $800 million and above, 4-star. If you are touching $800 million and above, you are a 5-star export house. So first state, what? First stage, $3 million and above. $3 million and above, but below $15 million, 1-star. $15 million and above, but less than $50 million, 2-star. $50 million above, but less than $200 million, 4-star. 3-star. $200 million and above, but less than $800 million, 4-star. If you are touching $800 million and exceeding without upper limit, in that case, it is a 5 million, you got 5-star export house. You got the clarity? This is one of the important criteria in the examination. Who are the star exporters? What is the criteria for them? The export turnover of the past 3 years plus current year as of now, the turnover. If it is $3 million and above, 1-star. $15 million and above, 2-star. $50 million and above, 3-star. $200 million and above, 4-star. $800 million and above, it is 5-star export house. I am an export house, my dear. If I import the goods, only for what purpose? Manufacturing in India. After that, finished goods I am going to export. In that case, why should I pay import duty? Allow me to import the goods without payment of import duty. If I export the goods, then I am not going to claim any export incentives, because the export incentive, what I supposed to be get post export, I am getting pre-export at the time of import itself. In that case, I am not liable to pay import duty. The benefit I got or not in advance. Therefore, it is called what? Advance authorization scheme. If that is the case, advance authorization scheme where the goods has been imported by me, in that case, I should have to have certain conditions to be fulfilled. What are the conditions? Hey, Mr. Exporter, manufacturer come exporter. I am using the word what? Manufacturer. I am not using the word for what, Raja? I am not using the word of a trader. I am a manufacturer, come exporter. I import the goods. Within which period I have to import? Once the license has been granted to you, advance authorization license has been granted to you, within which period I have to import means the time period has been clearly mentioned, my dear sir. If I got this license, very clearly mentioned that by saying that import of goods under the advance authorization must be made within a 12 months from the date of its authorization. Permission granted to me from the date of granting the permission, within 12 months I should import. It can be extended. Revalidation, further period of 12 months is allowed. After the authorization, import should be taken place within 12 months. If not sufficient, further revalidation will be further 12 months. Then once I import the goods, export obligation on me, because the goods are imported without payment of import duty. Therefore, I have export obligation. The goods what I imported is actual user condition. It is under charge, because I promise to department, I am importing without payment of import duty. Allow me to do so, and I promise you within a given period of time I export after manufacture. So department asking, you should export within 90 days from the date of clearance of import consignment, and no extension further is allowed for this particular export obligation purpose. You get my point, sir? Export obligation promotion, extension not possible. Within 12 months from that of authorization. What do you mean by authorization? Is a permission. Authorization means what? Permission. Permission granted to import. License given to you. Within 12 months from the license granted, you have to import. If not, further 12 months can be revalidated. Once you import the consignment, from that of import, you should manufacture and export within 90 days. No further extension for this particular export period. 9 days only final. Is clear, my dear sir? And when I export the goods, I should fulfill export obligation as a value addition. Minimum value addition must be, here is mentioned as 15% value addition. Meaning thereby, when I import the goods, I measured CF value. Am I right? Raw material imported, A, B, C, D I imported 100 lakhs. After manufacture, my FOB value of export must be 115. 15% must be VA. VA means value addition must be there. Then only you are redeemed export obligation. If I did not did so, if I have not did so, if I have not complied this particular provision within 90 days, if I have not exported, or even within 90 days from the date of import, if you export, not meeting the VA, then it is nothing but I have not redeemed export obligation. I breached the obligation. In that case, what is going to happen? No, the goods which I was imported without payment of import duty, now I have to pay duty with the interest and penalties. Is it clear? Amma? Purida Raja solradhe ardhamathundaya manisile. So what I try to say here is, once you import the goods under the advance authorization, manufacture and export within 9 days from the date of import of consignment with value addition of dash percentage 15%. Is clear, sir? Now here a facility has been granted to export exporters, export houses, star exporters. You know star exporters? Can you repeat the star exporter concept, please? $3 million and above, 1 star. $15 million and above, 2 star. $50 million and above, 3 star. $200 million above, 4 star. $800 million above, 5 star export houses. For them, how to arrive this particular million of dollars? For the past 3 years plus current year as of now. And moreover, hey Mr. Chartered Accountant, a cost accountant, in practice, you should certify this. Not chumma. Mr. Exporter, you get a certificate from practicing chartered accountant, cost accountant to certify whether you have been achieved your turnover of this particular limits or not. After having a certification from a CA or CMA, the DGFT will be grant you the status of star exporters. For star exporters, all the time whenever they import the goods and go and beg, yeah, DGFT, we want to grant what? Advance authorization. Too cumbersome. Therefore, we have an annual advance authorization concept. Annual advance authorization concept. For one financial year itself, we can get the license. Full bulk value. What is this means? Here, referring to you, 300% of the FOB value of physical exports in the preceding financial year or 1 crore. Previous year export performance how much? FOB value of exports. Physical performance means what? No? Physical performance, actual exports taken place out from India to outside India, not the deemed export. 300% FOB value of physical exports in preceding financial year or FOB value of deemed exports in the preceding financial year. That means exports, physical exports plus deemed exports in the previous year clubbed together. For example, it is total is, let us say for example, 80 lakhs. How much is it? 80 lakhs. Exports plus deemed exports together 80 lakhs previous year. 300% is 80 lakhs into 300% is equal to 2 crore 40 lakhs or rupees 1 crore. Whichever is higher. Which is higher? 2 crores 40 lakhs. 2 crores 40 lakhs worth of the raw material you can import under the advance authorization without payment of import duty. Meaning thereby, whenever you import part by part CF value, once consignment imported 100 lakhs, CF value 100 lakhs. Your permission, your license is 2 crore 40 lakhs. 240 lakhs. 240 lakhs minus 100 lakhs. But still you have license worth 140 lakhs to import CF value. Next time you import, how much? Sir, imported 50 lakhs, sir. Very good. 50 lakhs of CF value imported with the payment of duty. 140 lakhs minus 50 lakhs. Balance 90 lakhs. Like that, in a year, you can have annual advance authorization. But one thing is very clear. These goods what you imported not allowed to sell as it is, because these goods are under the actual user condition. What is the actual user condition? Whatever you import the goods, you should be manufacture and export with a value addition of 15%, meaning thereby, if you look on the screen, you come across here the actual user condition. In the given case, for example, in India, one particular exporter is imported the goods from USA, say value of 100 lakhs, A, B, C, D, raw material imported, Raja. A raw material 40 lakhs, B raw material 30 lakhs, C raw material only 2 lakhs, D raw material 28 lakhs, total 100 lakhs imported. After import of 100 lakhs of worth of CF value of import goods, after manufacture in India, exporting the goods within 90 days from of import with a value addition. Minimum how much should be there? 15%. So my FO value export, it should be, if I CF value of import 100 lakhs, now my FO value is equal to how much? Minimum 115 lakhs after manufacture A, B, C and D and export the goods. In case any product what I imported not able to manufacture because that is a finished product attaching with the final product. In that case, what you imported and attaching with the final product as it is and exporting, that value of CF value of import should not go beyond 10% of total CF value. For example, here I said D product 28 lakhs, C value 2 lakhs, B value 30 lakhs, A value 40 lakhs, total 100 lakhs. In that C product is a final product which I cannot able to further manufacture and exporting as it is with our finished goods. In that case, C value how much? 2 lakhs. In total CF value of import how much? 100 lakhs. 2 lakhs is equal to 2%, not exceeding 10%. In that case, the imported goods wanted to export as it is along with the final product, that value of import should not be exceed 10% of the total value of your imports. After fulfilling the export performance, after redeeming the export performance, then if any raw material left over in your factory out of A, B, C, D, that you cannot sell as it is. Manufacture and sell. Is clear, my dear sir? Here, who are the manufacturers eligible for this particular advance authorization? Eligibility. Manufacturer exporter, merchant exporter who holds AEO, advance the authorized AEO, authorized economic operator certificate, AEO, authorized economic operator certificate under the customs accreditation program, or the star exporters, status holders with a valid 2-star and above. Very important, sir. Manufacturers, exporters allowed, but if the star exporters comes into picture, the star exporter should have to have a 2-star and above. 2-star and above. Yes, Amma. Getting the clarity, Maharaja? The last. Are you getting my point? Star exporter. Who will get 2-star? Whose exports? How much? $15 million and above, but less than $50. They are called 2-star exporters, whose preceding 3 financial year turnover plus current year turnover, export as well as deemed export together. Do not average it, accumulate it. Is clear, my dear friends? Now coming to one more group is there. What is that group? One more second group, DFIA, which is called duty free import authorization. My dear sir, DFIA is considered, DFIA is not a pre-export benefit. It is a post-export benefit. Hey mister, once you import the goods, pay the import duty, BCD, IGST or any other duties you have to pay. Import the goods. The raw material of importing, you manufacture it or manufactured, sir. Export it, I exported, sir. Then only you are eligible for DFIA if you want DFIA scheme. In that case, who is eligible in the given case? who is eligible for this particular item, particular this scheme. Items, this particular DFIA eligible means manufacturer exporters. Manufacturer exporters as well as merchant exporters, supplies made to special economic zone units also be qualified. Meaning thereby, manufacturer exporter, you are aware of it. Who is a merchant exporter? Merchant exporter is he who is neither holding manufacturing unit in India nor processing unit in India. That means a person who has export orders in India but not having manufacturing unit, not having processing unit, neither manufacturer nor the manufacturer of industrial product nor manufacturing food products, but he has export orders in India, then placing the orders in India to procure the goods, and after paying the goods he is exporting the goods, is called what? A merchant exporter. So DFIA who are eligible? Manufacturer exporters, merchant exporters, supplies to special economic zone units holders are eligible to avail DFIA only after export. In that case, if they export the goods, they have to apply to RA, regional authority. What they have to apply? When to obtain the DFIA from regional authority means export shall be completed. Export shall be completed within 12 months from the date of online filing of application and generation of file number. Meaning what? This benefit no doubt will be granted to you only after export. But before export, you have to apply. I want DFIA. I am going to export now. Then in that case, within 12 months from the date of what we can call the within 12 months from the date of making the application for the want of DFIA, you have to export. Once you exported, after your export performance verified, regional authority shall issue a transferable DFIA, a negotiable instrument. It is like a DFIA is a called goods. On account of sale of the license to any other person, you are liable to pay GST, namely IGST. DFIA is a license. Duty-free import authorization granted to you only when you apply application online. From the date of making the application through online for the want of DFIA, you have to export the goods within 12 months. Thereafter, on account of verification, department satisfied, DFIA satisfied, where the regional authority RA will issue a license, transferable license to you, and it has a validity of 12 months. 12 months license. Within 12 months, you can import the goods without payment of dash, only basic custom duty. It is not going to be set off any other duties. Whereas advance authorization, I said no. When you import the goods without payment of duty, without payment of BCD, without payment of IGST, without payment of safeguard duty, without payment of the whatever may be the duty, is free from duty. In the case of goods are imported under advance authorization. Whereas DFIA license will be granted to you for a valid period of 12 months only to adjust the value of license, to adjust against what? Against basic custom duty only. It cannot be adjustable against the additional custom duty. Sir, within 12 months, if you have not imported the goods, then no problem. Sell off to somebody else. If you got a license of rupees 2 lakhs, sell for 1,50,000, and the person who paid to you for 1,50,000 will set off BCD up to rupees 2 lakhs. Thereby the buyer will get a benefit. So on account of sale of 1,50,000 rupees, this license is liable for IGST in India. You get my point, sir? Got the clarities? But this is not the actual user condition. Reason? Post-export, man. After export only I am getting the benefit. It is not has no export obligation. But one condition should be satisfied. The goods which I exported should have to have a value addition. When I import the goods, I pay the import duties. For example, Raja, A, B, C, D, I import the goods, which is 100 lakhs of safe value. When I export, there must be VA, valuation. What rate? 20% minimum required. That means my export should be 120 lakhs minimum. And one more condition. When I got license DFIA, that can be adjusted tomorrow when I import the goods without payment of BCD, only ABCD if I import. It's called SIAN, Standard Input Output Norms. Actually, I imported, Raja. First step 1, imported what? A, B, C, D. I imported. What imported? A, B, C, D I imported. Worth is 100 lakhs. I manufactured. When I import, I pay the import duty. When I imported, I pay the import duty. After I manufactured, I exported with the valuation of 100 lakhs. Now I am eligible for a DFIA. License granted to me for rupees 2 lakhs. It has valid of 12 months. 12 months, yes. Now within 12 months, if I import what? A, B, C, D, where I am not liable to pay basic customer duty to the extent of my license value. Is the conditions. With this, duty exemption scheme is completed. As I told you, there are two schemes. One is advance authorization scheme. Other one is what? Duty free import authorization scheme. Is clear? Now coming to duty remission schemes, where we have the following schemes. Duty drawback scheme followed by RODTEP schemes. I will explain to you, don't worry at all. First and foremost, look here. Look here. In the given case, duty drawback scheme, where there are three types of duty drawbacks that we have. We already referred in regular class also. One is all industry duty drawback. Other one is special brand rate. Other one is what? Other one is what? Known as, I referred, no, the brand rate, special brand rate, all industry duty drawback. Three are there, no ma. Now listen to me. Don't worry at all. You recapitulate. When all industry duty drawback rate applicable means, if the goods covered in the general export or import, all industry duty drawback rate applicable, where the minimum is 1% of FOB, maximum is 33% of the FOB value. If the duty drawback as per the all industry duty drawback, the recovery minimum should be what percentage there? I told you. Minimum FOB value on export 1% duty drawback, Raja. All industry duty drawback amount is how much I am getting as a duty drawback percentage. 80% and above. Correct, Amma? Then all industry duty drawback is applicable. 80% only I said, na? If it is below than the 80%, my recovery, then all industry drawback disappears. What is going to appear? Special brand rate applicable. But one thing, Mr. Exporter, when you go to submit the shipping bill for your export, you must be present in the shipping bill which duty drawback you want to claim. If you suppose you mentioned all industry duty drawback in the shipping bill, department admitted it, and export taken place, after that you want to shift to special brand rate duty drawback, not permissible. This question has been asked in the exam of CF final already. One can expect in the CF final or CMF final again. Is clear. This duty drawback is a post-export or pre-export? Post-export benefit. But ensuring that you should not be getting any other benefits. And also we are understood brand rate of duty drawback, where the goods are seldom or exporting, like HIV medicine or gold, what we call diamonds, the valuable things, which is generally not possible to list in the all industry drawback rate. All industry drawback rate general product, cloth, specs, watch, pen, paper. Whereas the brand rate is covering the special products, which is valuable, seldom import or export. In that case, brand rate will apply. Whatever may be the rate applied, the minimum is 1% FOB value, the maximum is 33% of FOB value. If the value less than rupees 50%, 50 rupees, that duty drawback not allowed. If less than 1% of duty drawback means minimum value should be 500 rupees and above to get duty drawback. We refer these points. Now coming to the other end, RODETP, namely remission of duties and taxes on exported product. What is this, my dear? Is a very unique nature, my dear. Be careful, listen. Earlier we had MEIS, export, merchandise export from India scheme. MEIS, merchandise export from India scheme. SCIS, service export from India scheme. These two are merged into one basket. Now we named it as RODTEP, remission of duties, taxes on exported products. But be careful, RODTEP scheme today is covering all type of duties suffered earlier at the central level as well as state level. Together you can get the benefit. Earlier only central excise duty benefit or the service tax benefit was there. Now state benefits also emerged. VAT, CST, octroi, entry tax, anything already suffered by you, you are eligible to claim the RODETP scheme, that benefit, covering all taxes, central and state levels. A new scheme it is. But who will get this benefit? No, exporters. Exporters, manufacturer come exporter only get the benefit of RODETP. You being a service provider cannot get this benefit. Service providers RODETP scheme is not applicable. Point number 2. Here the traders are disqualified to claim this benefit. Traders are not allowed. Merchant exporters not allowed. Merchant exporters not entitled to claim remission of duties, taxes and exported product. Yes or no? Is yes. Now come back, my dear. When you look into the given case, RODETP scheme is applicable on account of a manufacturer export the goods outside India. In that case, what is a reward scheme? Reward scheme is equal to FOB value of export product or 1.5 times of market price of the goods which is exported by you, whichever is less. Repeating again, duties credit script RODTEP, remission of duties, tax and exported product is equal to FOB value of export or 1.5 times of the market price of the goods, whichever is less, on which apply reward rate. One example I am bringing to a notice, reading as follows. During the financial year 25-26, S Private Limited has made the export of safety valves coming under the chapter heading 8481, country of export USA, UK, FOB value of export in foreign exchange 50 crore rupees. How much? FOB value of export 50 crore rupees. Market price of the export product in foreign currency converted into Indian rupees 30 crore rupees. Now 50 crores are 1.5 times of 30 crores is equal to 30 crores into 1.5 times equal to how much? 45 crores. So 50 crores or 45 crores, whichever is less. Which is less? 45 crores less, on which reward rate apply 3%. 3% will be given in the examination, don't worry at all. Is equal to how much comes? 1.35 crore is the reward amount under the RODTEP scheme, is only applicable to manufacturer cum exporters, not applicable to service providers. Further, so with this we have two broad schemes to cover. One is called what? Duty exemption schemes to cover, consist of two. One is advance authorization, other one is duty free import authorization scheme. Other one is duty remission schemes. In that, duty drawback schemes followed by RODTEP schemes. We covered or not? Now coming to further, my dear sir, the EPCG scheme, Export Promotion Capital Goods Scheme. Export Promotion Capital Goods Scheme. Here before going for the Export Promotion Capital Goods Scheme, if I got a license of RODTEP, which is license valid for how many months? No, 24 months validity of RODTEP scheme. It's a post export benefit, no export obligation. I can use the value of duty credit script. Just now I told you 3.5 crores, I said na, 3.5 crores duty credit scheme. How long validity? 24 months. If I have not imported, it can be sold to somebody else. Then I am liable to pay IGST. Is goods, license it is. Is clear? But this RODP scheme, my dear, adjustable against my import only BCD, not any other duties. RODP scheme. Is clear, my dear? Now further, coming to the point of here, look here, export promotion capital goods scheme. Sir, it is nothing but what you know, my dear, duty exemption scheme. In that, we refer one point, Raja. Which point? Speak out, na? Which point? Loudly speak out. Duty exemption, first point is what? Advance authorization scheme. Refer, no. That is for raw material, Raja. Simple, ma. For raw material. If I import the capital goods, advance authorization not apply. What is apply? Export promotion capital supply. So the concept behind it remains one and same. I am allowed to import the capital goods without payment of import duty. But that capital goods are used in the manufacture of finished goods, and the finished goods are exported by fulfilling the export obligation. There are two types of export obligation are there for me under EPC scheme. One is called average export obligation. Other one is called as the specific export obligation. Now, the scheme I am referring here. This scheme permits exporters to procure capital goods at constant rate of custom duty or zero custom duty. In return, exporter is under the obligation to fulfill the export obligation. Authorization shall be valid for a period of 24 months from the date of issue of authorization. Meaning what? Once the authorization, permission granted to import, within 24 months from the date of authorization, you have to import the capital goods. Revalidation of this particular EPCC shall not be permitted. Unlike of advance authorization. Advance authorization 12 months time period is given, revalidation 12 months. But here nothing, 24 months, that's all. Permission granted 24 months to import. Import within 24 months from date of authorization imported. I should use the capital goods to manufacture the finished goods and export the finished goods within a period of 6 years from the date of authorization. Meaning thereby, for the first 2 years out of 6 years, for the first 2 years I have to import. Balance 4 years time period is there to manufacture and export. Is the meaning of it. But these capital goods what I imported has actual user condition. Now, here, what about, am I permissible to buy the capital goods indigenously, locally? Yes, yes. If you are buying locally, you feel very happy. Allowed to buy. Further, as per holding on, a person holding on EPC scheme authorization may source capital goods from a domestic manufacturer either through indigenous or invalidation letter or through advance release order. Meaning what? If I am holding of EPC scheme, I want to import the goods, you can import without payment of import duty. But if I want to locally purchase, this advance authorization, namely EPCC license, I should invalidate to buy locally. You get my point, sir? Holding EPCC, you import the goods. No, sir, I want to locally buy means you most welcome. Invalidate your particular authorization or through advance release order. Get an advance release order from the DGFT and locally procure the goods. That is eligible. It's clear. If you purchase locally, the benefits are more for you. But ensuring that capital goods has actual user condition. After using that the capital goods in India to produce the finished goods, fulfill the export obligation. What export obligation we have to fulfill here? I am going to bring down this. Here, what export obligation should be fulfilled? I am going to explain to you, listen to me. Export obligation should be fulfilled within a period of 6 years from the date of authorization. Whereas advance authorization is considered, Raja, advance authorization is considered from the date of import of the consignment. Within 90 days, you manufacture and export the finished goods. Is clear? Got the clarity? But here, advance, this particular export promotion capital goods scheme is considered. 24 months time period is given to you for what? For import of capital goods or locally purchased by invalidating your EPCC or getting advance authorization order from the DGFT. Now, if you are import that goods, using that capital goods, manufacture finished goods and fulfill the export obligation, which is 6 years time period from the date of authorization, not from the date of import. Is clear? Next one, you have to fulfill the export obligation, which is two. One is average export obligation plus specific export obligation. Both you have to fill up. Means whichever is higher, if you fulfill within 6 years from the date of authorization, the other one automatically fill up. Is clear? How this should be is as follows. Furthermore, presenting for your kind consideration in the given case of EPCG scheme is as follows, my dear. Here presenting for a kind consideration. EPCG scheme, export promotion capital goods with the obligation. Look here. In the giving, do not direct your attention. What I am referring? EP, see, speak out please. Export promotion capital goods scheme. It is nothing but advance authorization, but advance authorization for raw material. It is a capital goods. Here, if you refer, my dear, in the given case, it is actual condition, has 24 months of time period, and I am diagrammatically presenting here. Just look and understand. For example, X Limited has advance authorization, valid 24 months, import the capital goods without payment of duty 20 lakhs. How much not paid duty on capital goods? I am going to import 20 lakhs. Duty saved 20 lakhs. Is clear up? And you should export these goods within 6 years from the date of dash importer authorization. From the date of importer authorization. From the date of authorization. Within 6 years of export by fulfilling export obligation. There are two export obligations. One is called average export obligation. Other one is called what? Specific export obligation. Average export obligation is nothing but for the past 3 years export performance divided by 3. Year 1, year 2, year 3, previous 3 years exports divided by 3. For example, Raja, it is 90 lakhs. How much, Amma? 90 lakhs. So all together, 3 years together, 90 lakhs export divided by 3 is equal to 30 lakhs. Then specific export obligation also should fill up. What is specific export obligation? 6 times of duty saved. How many times, sir? 6 times of duty saved. Duty saved, how much I said to you? I am going to import 20 lakhs into 6 years. 6 times is equal to what? 120 lakhs. So 90 lakhs average export obligation, 120 lakhs specific export obligation. Both should be filled up. Meaning what? Whichever is higher, if you filled up, automatically filled up the other one. Yes, Amma, the last. Understanding, Raja? Yes? Loudly speak out. Say, why you are so mum? Huh? Purida. Nalla sound. Nalla. Yes. அப்போ கொஞ்சம் நீங்க பின்னாடி நீ உட்கார வேண்டியதானா? நீதாம்மா இன்னும் சொல்றேன், உனக்கு என்ன கண்ணு தெரிய மாட்டேது, நீ அவ பின்னாடி உட்கார. நல்லா இருக்கும்பா, நீ வந்து எனக்கு பார்த்து வச்சுக்கல, நல்லா இருக்கும். நான் சொல்ல பாருங்க. Take the opportunity. It is a marathon class. You only ask me, no, your favorite FTP. I start with the FPP, Raja. Sit comfortable? Please be comfortable. Uncomfortable, tell me. Come and sit in here, front. Ukarla. Vanga. Incomfortable, vanga munadi va, Raja. Va. ஒரு சேர் இங்க வா, இங்க எடுத்துக்கோ. இந்த பக்கம் உட்காரு. இங்க உட்காரு. அந்த பக்கம் உட்காரியா? இந்த சேர் எடுத்துக்கோ. இந்த உனக்கு சேர் தனியா உட்காரு. FTP, you ask me. You should understand, no, Raja. உட்காரு, சும்மா அப்படியே வந்துடு. நம்ம things தான், no problem. No, all of you clear. It's a marathon. Is it? Super revision. I will revise again. I will ask you to repeat also. You will repeat. Now what we referred? Referring what? EPCC scheme. Export promotion capital goods. Is clear, Amma? In the case of export promotion capital goods, we are got authorization to import capital goods. Within which period have to import? Quickly. Within which period? Within 24 months from authorization. What do you mean authorization? Permission. Is clear? I should manufacture and export within 6 years from the date of dash authorization. Then I have to fulfill the export obligation. Well, there are two export obligations. One is average export obligation, other one is specific export obligation. In the case of average export obligation, for the past 3 years exports divided by 3, which is 90 lakhs. 90 lakhs divided by 3, 30 lakhs. Duty saved 20 lakhs. Now, specific export obligation is equal to 6 times of duty saved. 20 lakhs into 6 times equal to 120 lakhs. Whichever is higher, 120 lakhs. If I fulfill within 6 years from the date of authorization, exporting of dash 120 lakhs, I redeem export obligation. After that, this capital goods I can sell off to any person. Till the time, I should not sell the capital goods which I imported, because these capital goods are dash actual user condition. Because without payment of import duty, by saving the duty, I import the capital goods. Got the clarity? Got the clarity? Now here, one more advantage is given, Raja. Uruvela, in case, if you are able to export 75% of specific export obligation within less than half of the total obligation period. Total obligation period is equal to 6 years. 50% means 3. Within 3 years, if you are exporting 75% or above specific export obligation, which is going to fill up 100% of average export obligation, then the balance export obligation is not required to fulfill. You are treated as export obligation redeemed in our given case. 120 lakhs specific obligation. Specific export obligation 120 lakhs multiplied by 75% is equal to how much? 120 lakhs into 75%, Raja? 90 lakhs. 90 lakhs if we export within 3 years from date of authorization, which is fulfilling 100% of average export obligation, then you are free from fulfilling the further export obligation. Balance ever irukku? Balance 30 lakhs. Fulfill or not fulfill, not required. You redeemed export obligation. If you do so, repeating again, if you are exporting within 3 years 75% or above of your specific export obligation, which is going to fulfill 100% of average export obligation, then further export obligation not required to fulfill. Got the clarity? Suppose if you procure the goods locally, export obligation 2. One is average export obligation, which is past 3 years divided by turnover divided by export turnover divided by 3. Specific export obligation, instead of 6 times, only 4.5 times only duty saved. Sir, locally if I purchase, I have to pay the duty. No, sir. Yes, man, you have to pay the duty. You have to pay the duty. Duty means what? GST. Now, how can I identify duty saved amount, sir? In case if the indigenous capital goods, instead of buying, if we import, what would be the duty? 20 lakhs, sir. Take that as a deemed duty saved. As a deemed duty saved. 20 lakhs multiply with 4.5 times only, which is equal to how much comes here? 90 lakhs. So, if 90 lakhs is a specific export obligation, average export fortunately came 90 lakhs. So, you fulfilling both the obligations. That obligation should do so within 6 years from the date of authorization. Got the clarity, my dear? Any doubt among the given case of EPCG scheme? Now, locally I purchase, I pay the GST, no? I pay the IGST. Then that IGST, one can claim refund. One can claim. Whether holder of EPCC who purchased these goods by payment of IGST, he can claim a refund. If not, he can declare in the declaration, my supplier can claim a refund, provided the buyer should not avail the ITC. That time for the supplier, as per section 147, it is called as a deemed export. The deemed exporter can claim a refund by following the refund procedure under the section 54 of the CGST. Get my point, sir? Yeah, either one can claim refund, not both. Because one transaction, you can get multiple benefits. Got the clarity? Now coming to, I refer to you how many schemes? Export bonus scheme. First, duty exemption scheme. Second one, duty remission scheme. Third one, EPCG scheme. Now referring to you, furthermore, EOUs, EHTPs, BTPs, all these points. EOU, export one unit. EHTP, electronic hardware technology park. BTP, biotechnology park. STP, software technology parks. If they are manufacturing, exporting the goods, if they are doing so, if they import the goods, they are not liable to pay duty. If they export the goods, they are not going to claim the benefit because they got the benefit of non-payment of duty at the time of import. Get my point, Amma? Suppose anybody in India supply the goods to these holders, is called deemed export, liable to pay GST. In that case, one can claim refund. Either supplier can claim, if not, buyer claim the refund. Or buyer claim refund, if not, supplier claim the refund. Is clear, my dear friends? Is a scheme of EOUs, EHTPs. Then deemed export, just to refer to you, deemed export concept. But here, my dear friends, in the case of EOUs, EHTPs and all, they should get a license. That license is revalidating to them every 5 years once. If my unit is EOU, how I should get a license from the government? That license will be revalidated every 5 years once. In a block of 5 years, my import should be less than my exports. That means in a block of 5 years, I fulfill one obligation. A minus B greater than 0. A is our export, B is our import. This is not to be verified every year in a block of 5 years. If I, as long as fulfill this condition, A minus B greater than 0, A is our export, B is our import, then my license every 5 years once will renew as EOU, EHTP, BTPs. Get my point? Further, my dear, deemed export, this concept we referred, a person when become a deemed exporter, be careful, listen. If I supply the goods to a exporter, the exporter going to submit what? A shipping bill. In that shipping bill, that exporter should be mentioned supplier name. Then only the supplier to the exporter will be called as a deemed export, deemed exporter. If the shipping bill not containing the name of the supplier of the goods, then it is not a deemed export. Got the clarity, my dear friends? The benefit of deemed export, we are aware of it, we refer in the refund chapter, and also I am referring here again. If the refund, the supplier of goods after manufacture supplier to exporter, the exporter export the goods. Now, exporter giving in letterhead, I have not claimed ITC, refund can be claimed by supplier. And the supplier who supplies the goods to exporter should get a certificate from jurisdictional officer of a buyer place. That officer should certify, yes, my client in the given case has received the goods in his premises, and with that I have to apply for application for the want of refund. Then I can get the refund. What if I paid the IGST on account of supply of goods to my buyer, which is 147, read with section 54 of the CGST. Is clear, Amanda? With this I can say that export promotion schemes under the FTP is completed, but it is still incomplete if I have not complete special economic zone. Even though special economic zone is not covered under the FTP, I need to refer special economic zones under the final policy. Whenever I refer the final policy, I should be invite the attention on the part of the SCZs, because they are the real heroes of earning of the foreign currency into India. They got the benefits. They have got multiple benefits now. They got multiple benefits, my dear friends. What benefits they have means, listen to me. If I supply the goods to SCZ is export, though in India, though I am in Chennai, MEPS in Chennai. Goods supplied from DTA, domestic tariff area, to SCZ is called export as per section 16 of IGST Act. Can I get the export benefits? Yes. I should submit dash shipping bill when I supply the goods to MEPS in India, Madras Export Processing Zone. Though I am in Chennai, is export, is international supply, zero rate apply. Or I can choose to levy IGST on export and claim the same as a refund, but I should submit dash a shipping bill. When I receive the goods from the SCZ unit into DTA is import. The person who buy that goods liable to pay import duty, custom duties by submission of bill of entry. That means a unit of SCZ neither liable to pay duty on account of import, not liable to pay duty on account of export, not liable to pay duty on account of inward and outward supplies. These are duty-free zones, special economic zones. Got the clarity, my dear? Further also I can simplify mine to say that special economic zone units are competent to get RODTEP scheme, remission of duties, taxes and exported product on account of export. Sir, they are not liable to pay duty at all, sir. Why they get this benefit? What is the use of this benefit? This is a big benefit for them, because the duty, remission of duties and tax and export product, RODTEP scheme license is nothing but a license. If they are not going to pay duty, they can sell off to somebody else, they can encash the payment. So a cash back offer to our export units. So it is a helping hand to the SCZ units. So Mogaperi benefit yarke special economic zone units. But special economic zone units covering under the Special Economic Zone Act and rules comes under the Union Ministry of Finance, not under the Commerce and Industry Ministry, not under the Union Commerce and Industry Ministry. This entire final policy is under the regulation of the particular, what we can call here is Director General of Foreign Trade, where it is from time to time issuing the circulars, notifications to monitor this particular foreign trade policy. Now I can simplify manner to say that the DGFT is coming under the category of, under the regulations of, I can say that, Foreign Trade Development and Regulation Act. FTD and R, Foreign Trade Development Regulation Act 1992. Under that, the Ministry of Commerce and Industry governs the affairs of the foreign trade promotions with the help of a mentor, namely DGFT. DGFT circulars is a final, not the CBIC circulars. Under the foreign trade policy, DGFT act as a supremo mentor. Got the clarity? With this foreign trade policy, marathon is completed. Super revision is completed. Got the clarity? A quick recapitulation. I refer to you Foreign Trade Policy 2023 promotion of export promotional schemes. They are the following schemes. One is what? Exemption, duty exemption consists of two. One is advance authorization, other one is duty free import authorization. Coming to duty remission schemes, two schemes. One is duty drawback schemes, other one is remission of duties and taxes as per product. Thereafter, EPC is export promotion capital goods scheme. Thereafter, EOUs, EHTPs, BTPs, STP schemes. Thereafter, deemed export schemes. And finally, I invited SCZ schemes. As simple as this. Got the clarity, my dear? Now referring to you, section 67, inspection, search, seizure and arrest. These and all referring section 67, but each one has separate search and seizure, detention seizure 79 is there, power to arrest 130 is there. That are separately spread over individual sections. As a whole, inspection, search, seizure and arrest is considered. First, power to inspect or search and seizure. When you suppress any transaction, means malified intention to cause the revenue loss, the department comes for search. Excess claimed input tax credit, department is wanting to physically verify your records. They come for audit or they come for such purpose also, investigating purpose. There may be investigation. Business of transporting goods and have escaped payment of tax. Symptoms to invoke search and seizure. Goods shall be returned if no notice is given within 60 days of the seizure of the goods. Goods shall be returned if no notice is given within 60 days from the date of the seizure of the goods. Generally, if goods has been seized after the search and seizure, seize the goods, there must be notice. Time period is 60 days. If not given the notice, goods should be returned back. Is the concept of inspection, search, seizure and arrest. Arrest is later on. Further, inspection of the goods in movement possible. When any vehicle carrying the goods value exceeds rupees 50,000, where what is required? E-way bill required. If not there, the goods are liable for seizure. Power to arrest may take place when any person has committed an offence punishable under section 73 subsection 2 or subsection 1 clause 1 clause 2 of these sections, may by order authorize to any arrest such person. Commissioner will invoke section 69 to arrest a person, where if the arrest required, then only the arrest takes place. If it is a cognizable, non-bailable, then arrest is very important. If it is a non-cognizable, namely bailable, arrest not required to invoke. If arrested person is asked for bail under non-cognizable offences, which is bailable, the department assistant commissioner, deputy commissioner acting as a in charge of the police station should grant the permission of bail. You get my points? So this and all spread over again. When section 67 arrest is not arrest under section 7 is arrest section 69 power to arrest followed by section 120 what we can call 132. Get my point, sir? And the offense of a tax evasion should be more than 1 crore to arrest a person. You get my point, sir? If less than 1 or equal to 1 crore, only one case only arrest takes place. Section 132 subsection 1 class F falsifies the records, manipulates the records. That time only arrest may take place. Otherwise, minimum the involvement of the tax should be more than 1 crore. Get my point? That more than 1 crore but not exceeding 2 crores. Offense proved, imprisonment come 1 year. Arrested person during the arrest ask for bail, bailable offense, non-cognizable. The arrest comes into picture again 132, where more than 200 lakhs evasion of tax but not exceeding 500 lakhs. In that case, arrest takes place, bailable, non-cognizable. If offense proved, imprisonment comes into picture. Maximum period of how many years? 3 years. If more than 500 lakhs, namely 5 crores of tax evasion, if it's other than section 132 subsection 1 class A, supply of goods, supply of without issue of invoices. Class B, issue of invoice without supply of the goods. Class C, availing the fake invoices, input tax credit and causing revenue losses. 13, section 132 1D, namely tax collected but not paid for a period more than 3 months from the due date, where the evasion of tax more than 500 lakhs, arrest taken place non-bailable, which is cognizable offense. If it is arrest proved, 5 years imprisonment. If it is other than these offences, but amount of tax involved more than 5 crores of rupees, in that case, arrest taken place non-cognizable, bailable. Offence proved only 5 years imprisonment. If it is other than 132, 1A, B, C, D. Is clear? So, section 67, namely called as inspection, search, seizure, and arrest, leads to spread in other sections, linked with other sections. Is clear, my dear friends? Furthermore, anything is there? Shall I conclude then in that case? So, at this point of concluding the marathon relevant topics we have chosen for our exam point of view, not all the topics. In the name of marathon, referring all the is not importance. Referring the important topics, recapitulating exam point of view is important. With that, the CA final, CMA final, IDT, marathon, or I used to call super revision is completed. Thank you, my dear friends. All the best for exams. Thank you.